Are you ready to get serious about trading? Then join
That
Tasty
dragon's
Trade,
fire breath is
Investopedia's
intense.
best platform for
How do you
options
plan
trading
to
in
dodge it?
2026.
It's like a
Stocks,
dance.
options,
Maybe use the
futures, and
terrain
more.
to your
Tasty
advantage.
Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
You can't solve these things by discipline. So if you keep making the same mistake over and over again, and you think, I'll just be more disciplined next time, and then you make the same mistake again, at some point, you have to recognize, oh, this is me. This is who I am. And I obviously have 0 power to change this. How do I trade successfully in spite of this? Once a trader gets to that moment, it's a beautiful moment because they no longer beat themselves up. They no longer feel bad at themselves. And they start to build systems that work. They start to look at this saying, I am terrible. I'm always going to do this. How can I possibly trade with this flaw of mine?
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey, welcome everyone to Chat with Traders. If you're new to the podcast, a special warm welcome to you and to our loyal listeners. Thank you for your support and listenership. You keep us going. So we're on episode 287, and I'm your co-host, Tessa. Can I say, wow? I'm so excited about this episode. What do Ouija boards, Scrabble tiles, Kiwis, and March Madness have in common, specifically with trading? And when was the last time you ran an experiment to test a hypothesis? I love experiments, especially when they're complex and someone else has already conducted it, and all I have to do is review the results and reap the benefits of their awesome work. But I suspect I'm not the only one. Well, today our host Ian Cox chats with Rob Reinhold, a veteran trader of 27 plus years in the financial markets, and he's also the head trader and founder of Maverick Trading. We reached out to Rob because we recently learned about a very intriguing year-long trading experiment that just concluded that Rob calls the Flat Earth Trading Society experiment. Yes, you heard it right, Flat Earth. I just love it. Well, I won't spoil the details because I don't want you to miss this episode. And all I will say now, though, is that as a day and swing trader, I found this discussion so refreshing and so eye-opening. After learning about Rob's trading experiment in more detail, which, by the way, was conducted in a live trading account and shared publicly, I felt so relieved and hopeful for all of us traders trying to make it out there. Friends, if you have been beating yourself up because of trading or had a rough trading summer, please don't give up. I promise this episode will recharge you. On behalf of Chat with Traders, and I dare to say the entire trading community in the whole wide world, thank you so much, Rob and your team, for conducting and sharing this groundbreaking trading experiment. And by the way, we'll have links and information related to today's discussion in the show notes for this episode on our Chat with Traders website. So make sure you visit our website, chatwithtraders.com. And if you haven't subscribed to our email list, please do so we can stay connected. Now, without further ado, ladies and gentlemen, we are so pleased to present Rob Reinhold from Salt Lake City, Utah.
Well, officially, Rob, welcome to Chat with Traders, and let's dive right into your background.
All right. Well, it goes all the way back to 1997. Got a hold of some early books, and this was the very beginning of online trading. I decided that that's what I wanted to do with my life, is be a trader. And I decided to play around and kind of do it on the side and ended up doing pretty well. And then, like most people, pretty much common theme in trading is you do pretty well at first, and then all of a sudden you find out it's a little harder than you thought. It's the Dunning-Kruger effect for sure when we all start trading. Are you familiar with the Dunning-Kruger effect?
No. Tell us what is that? Sounds like something related to psychology.
Absolutely. The Dunning-Kruger effect is basically you start with zero confidence and zero information on a subject. And typically what happens is once you get a little bit of information, your confidence skyrockets to the highest point it will likely ever be. Even though you don't have any of the actual experience, you have this confidence that you do. And then the confidence comes down as you realize it's a little bit harder. And then at some point it bottoms out and actually starts to go higher again in the future, but you never really get back to that very first point of where you knew it all. And that's really probably around the 3 to 6 month mark of trading. I don't know. Did you ever experience that?
Oh, yeah. Yes. But maybe thankfully for me, I started off with some losers. So I got the education done early.
Perfect.
Yeah.
So I lost some of my money that I gained, and I learned about a trading firm called Maverick Trading in Salt Lake City, Utah. And I went in there and I was able to sit with other traders who had a lot more experience than me. And I can't tell you how much I learned just sitting next to people, because I had my way of doing things and I thought, hey, it's going to work. I've done some back testing and I was a real big fan of indicators. And the guy next to me, he was always buying things that had already gone up like 10, 15, 20%. And I thought, this guy's insane. This guy's crazy. I mean, he's just chasing things. And so I would buy the things that, quote, hadn't moved yet or were trading at a good price. After about a month and watching him pretty much win every day and me, have okay results, I realized, there's a lot more that I need to learn about this. So that's really where I started out, was 1997 and very early in the online trading game.
1997. So that was during the dot-com boom, right?
Yes. Yep.
Right.
The boom and then the bust.
What made you seek out a prop firm? Because I remember I was trading back then and I didn't even know such a business existed. All the traders I knew, they just traded from their computer and they thought that was good enough.
At that point, Maverick Trading actually was not a prop firm. They were just a regular broker dealer. The difference was you could go into their office and they had a T1 internet line. They had all the systems to where you could actually trade real time. Because if you remember back in 97, you really couldn't get internet in your house that was reliable at all enough to trade. So the only way you could really do this was to find a firm that had an office.
So you didn't have any other career aspirations? I mean, did you get sucked in? Back then, there weren't any Lamborghini videos showing off how much money traders made, right? Did someone introduce you to it?
Well, I'm trying to think of how I got introduced to this first. I met a gentleman who did some real estate when I was 19, and I thought that was just really cool and just a really cool way to do business. So I got all fired up about real estate, and I started doing stocks on the side. And I just realized that stocks were a lot easier than buying and flipping houses. I love buying and flipping houses. It's still something I think is just phenomenal. But it's a lot of work, and your capital is tied up for like 6 months. So I was having this boom and bust where either we had a lot of money or we had a bunch of houses that needed to sell. And I just said, I want a more smooth existence. And of course, again, Dunning-Kruger effect. I want a smoother way to make money. Let me be a trader.
When you started taking losses, is that when you discovered the Dunning-Kruger effect? Did you seek out this knowledge?
Seeking out this knowledge, I'm not totally sure what you mean by that, but just the knowledge of being a profitable trader. There's, as you know, thousands and thousands of ways to be a profitable trader. And the entry is the smallest part of a trade. And what really got me over that hump was position management, is having solid position management. And I found that through the use of options. I found out that as I got a little bit more seasoned, I could be disciplined 9 out of 10 times. And 9 times out of 9, I was perfect. And then 1 out of 10 times, I would just mess it up. So I got into options and I realized, hey, with an option, I can position size for max loss, where I literally can't lose more than whatever it is I have determined. That right there made it to where I didn't have to fight the battle 9 out of 10 times doing it right and then losing it. I automatically made it to where I literally couldn't lose any more than just my, 0.5% of risk or 1% of risk or whatever I set it at. That really helped get me over the hump because, as we all know, trading mistakes are pretty much what kill young traders. And it's all on the position management. It's not on the entry. It's on the exit.
And so it sounds like you at an early stage, you got into trading aspects that many traders sometimes take years to learn. Was that a result of being around other traders that really helped ramp up your education?
Absolutely. And one of the first stories I remember hearing from one of the guys at Maverick Trading is he told a story about there was two guys, and again, it was all like second and third hand stories that you heard back then before the internet. And the story was that there was two traders and they had a premise that it didn't even matter how you pick stocks. And to prove this, they hung up the Wall Street Journal pages on a wall and threw darts. And whatever stock the dart hit, they flipped a coin, heads they went long, tails they went short. And their premise was, it doesn't matter how you choose them, all that matters is how you manage them. Basically, selling losers and holding winners. And the story went that they did this for 18 months straight, picked 10 new stocks every month, and they never had a losing month. Wow. I have scoured the internet for this information. I have gone everywhere, and I've even asked in public forums, and I think it was part of the Turtle Traders system, if you've ever heard of the Turtle Traders.
Yeah.
But it only exists as a story. Mm-hmm. The data does not exist. So that's actually why I started what is called the Flat Earth Trading Society, is because I wanted to have this data to prove to the world that it doesn't really matter how you pick them. It's all about the management.
Well, that is a good segue. I watched many of your videos on YouTube on the Flat Earth Trading Experiment. It's kind of a funny name. What was the catalyst for choosing that name? It's quite amusing.
Oh boy, it was fun. I wanted to do something that, was conspiratorial, or something like, get catchy. In retrospect, I actually hurt myself because all of the videos on YouTube are labeled with a disinformation warning that the earth is not flat, that the earth is actually round. And so I probably got punished by the algorithm, but not a big deal. But I wanted to basically say, hey, that the thing that you've been led to believe, that the entry is so important, because if you go out there and you look at all the books, all the magazines, all the websites, 99% of it is about the entry. It's all about the entry. Oh, getting in at the right candlestick, getting in at the right moment. And there's very little about the exit. And the exit is where the money's made. And we've all heard that. Even new traders know that's true. But yet 99% of the information out there is all about the entry.
Why do you think that is? Is it just sexier to talk about the entry?
Yes, it's absolutely sexier to talk about the entry. And if you think about, stories you tell about, when you got in, you never brag about really when you got out. It was always like, oh, I got it at the perfect moment, or I got in at the right thing here. Very rarely do people ever talk about the exits. The entries are just much sexier.
So you created this experiment, and then what were the rules for this experiment?
So I determined we were going to do 100 trades. And in the initial video, I talked about why I believe this was going to work. And the whole premise is, and we talk about this with our traders at Maverick Trading all the time, is that you're going to make 10 trades. So let's just say that any trader out there, they're going to make their next 10 trades. And they're going to do their research. They're going to look at their charts. If they do fundamentals, they do fundamentals. The only trades they're really going to make are the ones that they think are actually the best. Those are the only trades you end up making. Here's the irony. Even though you tried as hard as you could, you got into the charts as much as you could, here's the irony. 4 out of 10 are going to be losers right off the bat. 4 out of 10. You did everything perfect. Did it all right.
Yeah, why is that? I mean, why 4 out of 10? would be losers?
Look, I'm just throwing out a number.
Okay.
So let's say you had a 60% win rate in your trading.
Mm-hmm. Mm-hmm.
That means that 40% of those ones you thought were great were actually terrible. The only reason you made them because you thought they were good. So I'm just throwing a number out there. And then out of, let's say 3 or 4 of them, they're going to be okay winners. They're going to be okay, not fantastic, but okay. And then in that group, you're going to have only 1 or 2 of those trades are going to take off and either run if you're long, go down if you're short. Only 1 or 2 out of 10. And actually, if you take a look at the worst ones, you will likely have 1 or 2 that turn into real serious losers. Now, remember, you took all these trades because you had all the lights, you had all the green lights, you had all the everything. And I talked about how this is trading. You need to understand that whatever system you use, you are going to get a bell curve distribution of results, period. It's always going to be a bell curve. Most of the trades you make are going to be somewhere like pretty good, pretty bad, somewhere in that middle. And then you're going to have your next ones that are, these ones were really good or really bad. And then out of 100 trades, you're going to have at least 1 or 2 that are absolute home runs that just run and run and run and run. And then on the other side of the bell curve, you're going to have 1 or 2 that are literally the worst trade you've probably ever made in your life. Now, that is a guarantee. Now, we all think, oh, no, I just won't pick those. That's not an option. You do pick them. So the premise was, hey, if we simply cut off the left side of that bell curve with and again, we used a 2x ATR trailing stop. It was a pretty simple strategy. I wanted it to be simple. I've had people reach out and say, Rob, is that the strategy? I'm like, no, there's much better ways to do this. But it was a simple 2 ATR trailing stop. So for people that aren't familiar with average true range, it actually measures the average volatility of a stock. So a more volatile stock gets a wider stop, and a less volatile stock gets a narrower stop. So it's just dynamic on the volatility of the underlying. And then our rule was that, again, we put in the 2x ATR stop. So if it goes against us, as soon as it hits 2x ATR, it's gone. And we did 1% risk, 1% risk on every single trade. And then the rule was if we did get to a 2x ATR profit, then we'd use a dynamic system and we'd move up to 1.5x ATR. So just snugging up that gain a little bit, or that stop, to make sure we have a gain. And if we got to 4x ATR, we then moved to a 1x ATR stop, and that was it. So we ran this over 100 trades. I started this experiment on August 1st, 2023, and we finished it somewhere around July 20th of 2024. So it took almost an entire year to go through this.
Did you expect that it was going to take this long, or was that your expectation from the beginning?
I really didn't have an expectation of how long it was going to be, because I was just making these trades when I had free time. Whenever I had some free time, I'm like, hey, I got time to do one of these. Because unlike just making a trade, you have to go live, make a video, do editing, do all the stuff. So it was a probably 30 to 45 minute process to actually make a trade, make a video on it, and produce it and upload it. So it ended up being about 3 to 4 trades per week, and we were trading off of the daily chart. So these trades weren't, super quick trades. They typically lasted, I actually don't have the data for that. I got a lot of data for you, but I don't have the data for the average holding period. My guess would be the average holding period was around 12 days.
And that's because of where you put your stops, or where your system that you followed. You would either raise a stop or you get stopped out early. And so that was just as a natural, it just happened naturally.
Correct.
How long you're...
Yeah. And if let's say we used a 1x ATR stop, that would have definitely shortened the length of a trade. And if we made it wider, we'd be in things for longer, for sure.
Well, how did you get a chance to pick the stocks? I mean, what was your method?
Well, I used a lot of methods, and I wanted to have fun with this. I wanted this to be a fun experience. So we did some Scrabble tiles. So I bought some Scrabble tiles and dumped them out on my desk and filmed it. And I just flipped them over at random, and whatever ticker symbol they made, then that was the stock that we picked. And then what we did, we did have a trend following rule, because we're big trend following adherents at Maverick Trading. All of the data, all of the research shows that there is an edge in following the trend. Our basis, or our decision of long or short, was based on the slope of a 13 period estimated moving average. So just whatever the slope of the EMA was at the moment, we went either long or short based on that. We used lots of other fun things. I even bought a Ouija board. My wife was not happy about that. She's like, "You can't have that in the house." So I had to leave it out in the garage when I wasn't using it to pick trades. And it was dumb. I closed my eyes and I ran my hands over, and whatever letters it hit, those were the letters. And then we made a ticker symbol out of it. I do a lot of travel. So I traveled over to Europe for about a month or two during the experiment. So when I was in Spain, we chose some stocks headquartered in Spain. When I was in Germany, we did some stuff with Germany and some ETFs. So had a lot of fun. I tried to keep it pretty interesting. Lots of some sports stuff as well. We did some March Madness picks, based on the teams and where they were headquartered. I tried to make it as random as possible, just to show that, hey, you know what, there is no cherry picking here. It's truly random.
Did you use the 13-day EMA because you've used it in the past with good results?
Yes. Okay. But again, that 13 was selected for the 2x ATR. You got to make sure you're matching up all your indicators with your position management. You can't use really short-term things to get into a position and then have a very loose stop. I mean, you could. Look, if it tests out and you back test it and test out and it tests out well in demo trading, sure, you could use it. But typically you want everything to match up as close as possible.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
And what's a chance using a 2 ATR stop? What is the chance of getting stopped out, say, within a certain period of time?
Well, look, we actually didn't even discuss this beforehand, but if you watch the first video, we talk about there's around a 33% chance that it's stopped out within the first 5 days. And the way we measure this is through the options market. So if you pull up some options chains and you run some analysis, it tells you, hey, this is the odds of a stop out in the first 5 days. So we knew right out of the gate that roughly a third of our trades we made would be stopped out in the first 5 days. We just knew that based on statistics.
Uh-huh. Uh-huh. When do you move up the stops again?
So the rule was if we got to a 2x ATR profit.
Mm-hmm.
So for example, there's a $100 stock that has a 2 ATR.
Mm-hmm.
That means the trailing stop would start out at $4 of a trailing stop, which is at 96. And then for those of you that don't know what a trailing stop is, it moves with the stock. So if the stock goes up a dollar, the stop moves up a dollar. If we would get to 104, which would be the 2x ATR target, we would then move our trailing stop to 1.5x ATR, just snugging it up a bit. At 4x ATR, we'd snug it up a little bit more to 1x, and then that's it. And then nothing was done after that.
Did you ever get any stocks that continue to run even with such a tight stop?
Yes, and it was actually our biggest win. It was when I was traveling down in New Zealand, and I was at this just amazing waterfall. And for any of you who've been to New Zealand and any Kiwis out there, I can't wait to come back to your country. It's amazing. It's covered with water everywhere. So I'm like, hey, let's do something with water. So there are a few water ETFs. ETFs are just they bundle together some stocks that have to do with water. And that was our largest and longest winner. So we made, I think it was like 7.5x ATR on that one. And I want to say we got into that one end of January and didn't get stopped out until like mid to late March. So that one was like probably 45 days of length that it just continued to move without a big enough pullback to knock it out.
Wow. Yeah, that is quite a long time.
But out of 100 trades, that's guaranteed to happen. I mean, out of 100 trades, if you let your trades run that are going to run, you will get 1 or 2 out of 100 that are going to do that.
So that's just a statistical fact or figure that you're just going on the laws of statistics that eventually you don't know when you're going to hit that big gainer, correct?
Correct. Mm-hmm. But we also need to admit that we're also going to pick a stock that goes against us like that just goes against us and over and over again, every day going down without any sort of meaningful bounce. That's why we have the trailing stop in there to cut those off and limit them to a 1% loss.
Wow. One of your videos, you said, trading is trading. It doesn't matter what you trade. So just curious, how is this? Are all markets the same?
No, all markets are not the same. But all trades, it's a ticker symbol and a price. That's it. And that the ticker symbol, whatever it is, the underlying, is going to go up or down based on supply and demand, period. So that's what I mean by trading is trading. Mm-hmm. It's universal. If you're trading gold, if you're trading bond futures, if you're trading Forex, everything you're trading is a symbol that has a market price that goes up and down based on supply and demand. Now, there's lots of little rules you got to learn for different markets, a lot of leverage rules or margin rules, and every market is going to have different levels of volatility. Some markets are going to be much more volatile. But in the end, I use the example of that driving is driving. You could drive a go-kart, you could drive a steamroller, or you could drive an F1 car. In the end, the mechanics are pretty much the same. They all work the same, but some go faster than others and some are more dangerous. And there's little things you have to learn. But that's what I love about trading. It is universal. Once you really get it down, you should be able to trade every single market out there.
I noticed that after you've done 59 trades through the system, notice that your account was near break even. And so I'm just curious, after so many trades, one might think that this experiment is a waste of time.
Yeah. And at trade number 59, I was thinking that myself. As you can see, look, when I did this, I said, look, this could fail terribly. If we just got a bad batch of statistics where, hey, something happened and just it didn't match up to the market a certain period of time, I knew that at the end of 100, there was a possibility that it could be at a loss. Like I fully knew that and understood that. And at trade 59, I said, oh, we'll see where this goes. We'll see where it goes. But look, that's trading. That's trading. You just slug it out day after day after day after day, have more winners than losers, win bigger than you lose, do it over a long period of time, and you're going to be really successful.
So tell us about the losing streaks. What happened with there? I imagine you probably had a losing streak somewhere along the way.
Yeah, we did have a losing streak. And just, we haven't yet talked about total return. Let's just get that out of the way. So the account was up like 15%. So we started out with a $100,000 account, and it ended up right at 115,000. So, overall, there was a return on it. Did it beat the S&P 500 during that time? It did not. It did not. And I've even had some people say, oh, this experiment was dumb. It didn't even beat the S&P 500. I'm like, look, that was not the point of it. I was using a Ouija board, for goodness sakes. Like with good entries, you can add on that. And that was the point of the whole experiment. If you have your position management down and it's really good, you should be profitable. I don't want to say right away, because that's giving people too much false hope. There's a lot of work to do, but you're at least starting in a very good situation as a trader, to where then your entries really start to matter. So let's talk about the streaks, because this was the most interesting part of the entire experiment. And I've been trading now for 27 years, and it still surprised me. Like, oh my gosh, this is amazing. So our best streak, we had 3 streaks that were the same. The most we had was a 5-win streak in a row, but we had that 3 separate times. The largest streak we had was from December 11th to December 20th. And that was a gain of $8,600 or 8.9%. So we had this really big gain right in early December. Now, interesting, when do you think our longest or worst loss was?
Probably right before or afterwards?
Right after.
Interesting.
And so again, this is just totally randomized trading. This is picking stocks out of a hat. But just like in real life trading, you have streaks. And one of the things we talk with our traders is we give them charts that show, like, if you flipped a coin 100 times, what are the odds that you would have 7 losers in a row? I actually do know the odds. It's about 42% of the time.
Well, really? 42% of the time, you would have 7, you would flip the coin and you'd have like 7 tails in a row.
7 tails in a row or 7 heads in a row.
Really?
So statistically speaking, you're very highly likely to have 7 winners or 7 losers in a row. That's just statistics. Well, what happens in trading is once we have these streaks, we either start to think we are the dumbest people in the world, or what is my Achilles heel in trading and really hurt me in my first probably 5 years in trading was after I had the winning streaks, I started to think I was really smart. And I'd say, Rob, man, you got this. You did it. You found the Holy Grail. You did it. And you get, lots of confidence. And for me, I'm a big extrovert. So when I get like excited, I want more. So I want more gains. I want more trades. I want more position sizing. I want more of everything. So what happens is, of course, that leads to a really big drawdown. That is all psychological problems that we bring on ourselves as traders. But this is just purely statistics. So we had our worst drawdown was from December 20th to January 24th. And that was 10 out of 11 losses. And the one in there that wasn't a loss was a break even. So let's just call it 11 losses in a row. So right after we had that big run, we had the longest and largest pullback of the entire experiment. Now, again, as traders, this is exactly what happens. And we get into psychology of what's going on in our minds. We have the big runs, we start thinking we're smart, and we get aggressive. And then we have these big pullbacks, and then we start thinking we're not good. And then we talk about things like, well, maybe I shouldn't take the next trade my system gives me. Maybe I should, just sit out for a week or two. When do you think we got our largest gain of the entire experiment?
What, maybe after a long losing streak?
Yep. Yep.
Interesting.
That
Yeah.
that stock I picked in New Zealand was the
Mhm.
largest gain, and that came after an 11 loss streak. So if you would have chickened out, if you would have backed away, if you would have deviated from your system, you miss those moments. And the whole point of this experiment, and this has kind of been the tagline at the end, is that consistency beats intelligence every single time in trading. If you want to be good at trading, stop thinking you're so smart. You're not smarter than the market. Start thinking about, how do I consistently enact a system that has an edge in the market?
Mhm.
And that's what this whole experiment was about, is just to show people what an absolutely robotic system can do for you if you don't deviate from the rules.
So in this experiment, did you use any top-down or sector analysis to manage your positions?
None.
None. Interesting. Wow.
Well, again, but that was the point. Now, in real
Uh-huh.
trading, you should absolutely do that. But
Mhm.
remember, I wanted this to be as close to 50-50 randomized as possible. So no, we didn't use anything like that. This was purely just 2x ATR.
I like to go back to when you said that after you have had a long winning streak in your earlier years, that you would get overconfident, and then that would end up leading to losses afterwards. And I'm just curious, what about the different quality type of setups and increasing position sizing based on the quality of the setups?
Great question. I think there's a couple questions in there. Let me first tackle the first part of my Achilles heel of getting overconfident. It's something that really just got me. It really took me probably about 7 or 8 years to really do it. And the last major mistake I made on this was 2008. And I still remember, and I got to tell the story just to help everyone out to where they don't do this. During the collapse in 2008, I love pyramiding in Forex. That's one of my favorite strategies, is to pyramid. Now, pyramid is you take a position and then you add on to the position if you have a gain. And if you have more of a gain, you add on more of a position. Now, it only works when there's major moves, but I pyramided into 44 lots of Aussie yen short. And the market dropped, everything fell away, the yen was spiking. And I remember that trade was my biggest trade up to date of like $185,000. And it was like awesome. I'd been building this trade for a couple of weeks, adding on. And then again, all the banks started collapsing, and it was just a great gain for me. And I remember just being on top of the world. And I even told myself, Rob, this is where you're dangerous. So why don't you just not trade for a week? Why don't you just not trade for a week? Well, I didn't have the discipline to do it yet. So my next trade, and remember, I said as an extrovert, my next trades need to be bigger and better and more. I started with 100 lot position in a Forex trade. That is
Wow.
a giant trade. And I remember when I hit the button, my P&L showed negative 3,500 just from the spread.
Oh my God.
And I remember when I saw that, I thought, uh-oh. But again, I didn't want to take that loss, and it went against me, and I closed it out finally and gave back about half of what I had made, building that trade over weeks and weeks of very meticulous, methodical trading. That's something that I have really struggled with. Now I'm so happy to say that I haven't made that mistake in, 15, 16 years now. And I don't have any compulsion anymore. And that's what's really nice when you trade long enough to where you don't even have the compulsion to mess it up. All right. So that's the first part of your question. The second part was about a dynamic position sizing system. I love it. I absolutely love it. I'm a big fan of basically having a system where you take larger positions when you have better odds in your favor. And we teach this to all of our traders in Maverick Trading, and I give a poker analogy. Now, do you play any poker?
No.
Okay. Well, poker works just like trading. You get a couple books, you learn about the odds of the hands, and all of a sudden you go to, Vegas or something, and you think you're pretty good.
Mhm.
Well, there's a lot to learn about in poker. Even if you have an ace, depending on where you're sitting on the table, your odds are dramatically higher or dramatically lower. I didn't understand that when I played poker at first, but I learned it and I realized, oh, my odds completely changed with ace if I'm on, the worst position on the table and there's 9 other players trading. I might only have like a 60% chance to win. But if I'm in the best position on the table, I might have an 85% chance to win.
You're saying your location relative to the dealer?
Yes, absolutely.
Wow.
It's basically when you get to bet. There are places where you have the ability to either fold or to raise that give you a big advantage. It's really about when you are betting, not specifically where you are on the table. It is where you're on the table because that changes as the dealer goes around. So yeah, they're different odds. So I absolutely love the idea of dynamic position sizing, but it has to be done the right way. Most people use it with how they're feeling at the moment. And, I shared this with you a little bit earlier. One of the things I love to study psychology. And I tell people I haven't read a book on trading in probably 15 years. All I read is behavioral psychology and how the brain works. In one of the studies they did, they hooked people up to an MRI machine to measure their brain activity. And they made them play blackjack. And during the game of blackjack, they were just playing. There was no money involved. Pretty much all of the brain activity was in the prefrontal cortex, where logic and reason is. Then they gave them money, and they got to keep the money that they either won or lost. Keep the money they won. And all of a sudden, the MRI showed less brain activity in the prefrontal cortex and a lot of activity in the insula, which is where our fight or flight response is. When there's money on the line, you are literally using the wrong part of your brain to make decisions. And so we talk to our traders about this, and we say, look, your position management, it has to be clearly defined. And if you can automate it, automate it. Because you are literally incapable of using your prefrontal cortex when you have a position with money on the line. Now, look, as you get better as a trader and have more experience, you'll probably be able to use more of your prefrontal cortex in those moments. But in the beginning as a trader, I'm guessing it's almost all fight or flight.
Interesting. So some say that, again, that we are not the same person after entering a trade that we were just prior to the trade, because why? That other part of our brain kind of takes over because there is money on the line. We have skin in the game.
Yes. And there is a fantastic book called The Hour Between Wolf and Dog. That's the title, by Dan Coates. It's a great book. It's a trader who used to work on trading floors. And when he was there, he saw some people rise to the occasion and seem to make the best decisions when there was pressure on the line. And then some people just fell apart and made the wrong decisions. He was super fascinated by that. So he actually went back to night school to get his neurological degree to study the brain. And the book he wrote was about what happens between wolf and dog, to where it's kind of like Dr. Jekyll and Mr. Hyde. What actually happens in the brain. And there's tons and tons of research in that book of what scientists have gone through and shown that, yes, we are not fully capable of using logic and reason in situations when money is on the line. It's just a phenomenal book. I highly recommend it to everybody. It's a tough read. It's a tough read. It's very scientific, but it's fantastic.
I see. So creating a system is essential for protecting ourselves from our other selves.
Absolutely. 100% true. I mean, you nailed that one.
Interesting. So this process of you kind of discovering yourself and your tendencies, you started in 1997, and it wasn't until 2008 that it really hit home for you, the need to establish a system?
Oh, no, it was definitely before that. That was just the last time I had, really messed up and
Hmm.
deviated from my system and done, done something I probably, in hindsight said that was an emotional decision based off of emotions, not on logic and reason.
I see. So if you were hooked up to an MRI machine back then in 2008, then maybe you were using the other part of your brain that's not necessarily good for trading, right?
No doubt about it. Absolutely. If I was
Mm.
hooked up to an MRI machine, you would be able to look at the graph and say, "Oh, he was out of his mind." And that's why it's so important as a trader to really understand this because you that's why traders fail. Traders fail because in those moments they deviate, they fall apart, they move stops, or they're scared and they don't take a position that they know they should. So, out of their last 10 trades, they missed the two good ones. We talked about how there's going to be two great ones in that group of 10, but what if you chickened out on those because you just had three losses in a row? It's all about following systems and being consistent. It's just so important. And I learned that early on in life, and I was really happy that I took a real deep dive psychologically after about 2 or 3 years and just really started to learn everything I could about this. Because I asked myself the question, and I'm sure you and every other trader who's ever traded before, how in the world can I be a disciplined person? I'd love to go to the gym. I'd love to eat right. I have no problem in all other aspects of my life. Why can't I follow my rules in trading? Have you ever asked yourself that?
Yeah. Yes, certainly. And what do you attribute why traders can't follow their own rules? Is it just it's just a weakness of human beings, how we get overwhelmed by prior to making the trade, we can be very analytical and logical, and once we're in the trade, we're a different person.
Yes. Yes.
Hmm.
And again, this is where I got to that I think is a really healthy place for all traders to get to. I used to beat myself up. I tell people trading has brought me to tears on two occasions. And we can talk about those times later if you want to. But you have to understand that there's no way you can do it. So once you get rid of the fact that it's not discipline, you can't solve these things by discipline.
Hmm.
So if you keep making the same mistake over and over again, and you think I'll just be more disciplined next time, and then you make the same mistake again, at some point you have to recognize, oh, this is me. This is who I am, and I obviously have zero power to change this. How do I trade successfully in spite of this? Once a trader gets to that moment, it's a beautiful moment because they no longer beat themselves up. They no longer feel bad at themselves. And they start to build systems that work. They start to look at this saying, I am terrible. I'm always going to do this. How can I possibly trade with this flaw of mine? And then they change and they build systems around their weaknesses, not trying to just be disciplined on their weakness. It's a beautiful moment for traders when they stop beating themselves up and start really saying, I am terrible at this. Let's never put me in this situation.
Hmm. So the discipline then that's needed comes in designing your system and setting clear rules and just following the system.
Yes, yes. And again, we've heard differently. And so many people are still, fighting for that discipline. And it's because they're doing things that is inherent in their nature. At one of the trader expos years ago, I gave a guest speech. And the first thing I got up and said, I said, look, and it was probably not all that nice. I said, hey, look, we have all of these booths here with all this software, with all of this help, with all these wonderful products to help you as a trader. Here's the problem. None of them are going to work. Why? Because you suck. And I sat there quiet for about 2 or 3 seconds. And everyone was like looking around like, what? What did this guy just say? And I said, look, I suck. Let me tell you about me. I'm a chronic overtrader. I get really confident after a long winning streak, and then that's when I do dumb stuff. So it started to become like an AA meeting. Like, hello, my name is Rob. I'm an alcoholic. Hey, my name is Rob. I'm an overtrader. I do this all the time, and I can't seem to not do this problem in trading. And I started talking about, yes, admit it. It is liberating when you just own it. Own your failures. Own your things you cannot use discipline to overcome. Own them, and then really start thinking about, how do I trade in spite of my negative personality traits?
Why do you think many traders believe they can significantly beat the market? I mean, is it just the Dunning-Kruger effect, just general overconfidence that's built into human beings?
Yes. I mean, the answer to that is yes. You ask people, how many, if they did a poll on this, they asked how many people thought that they were above average intelligence. Now, again, average is 50%, but 81% said yes, that they were above the average of intelligence. So yeah, we do this as humans. It's one of the things that makes us amazing. We're optimists. We think we're great. We tackle things that we should have never had any right to tackle, and yet somehow succeed at them. It's a really good feature of humanity, but it also, you need to be realistic about it as well.
So if you were to run the system again or something like this, or in how you trade, what are some entry strategies that you would implement?
Over the years, I have really gone towards this experiment where entries are very important in the fact that you need to have entry strategies just for the reason that you're not following emotions in trading. But when we come to entry strategies, there's thousands of strategies that can be back tested and shown to have an edge. So at least again, I do all styles of trading, but I mean, should we talk stocks? Should we talk options? Should we talk Forex? I mean, they all have some different strategies that I use.
Yeah, let's do stocks.
Okay. As I said earlier, big fans of trend following. So we like to get, multiple time frames all in the same direction. So, you've got a weekly chart going up, a daily chart going up, and let's say you're trading on like a 4-hour chart. The best trades you're going to make are going to be where everything is lining up and it's in a major trend. If you're trading stock, you are trading delta, or you're directionally trading. How much money you make is going to be determined by the trend of the market, the sector, the industry group, and the stock. All of that is going to determine how much it runs. That's going to make the best trade. So when you're out there looking for, quote, the best trade is the trade that went up the most in the time frame that you traded it. So the question is, how do you find that? And we like to go in and get multiple time frames in order, and then we're big believers in relative strength, to where you finally identify that right now, let's talk about where the market is right now. Technology is the worst sector. Semiconductors are the worst industry group. So we believe you go in there and you find the worst performing semiconductor, and that's the one you go short. Mm-hmm. Now, here's the problem. That one's already gone down 30%. My early trader, Rob, would say, I can't short that one. It's down too much. Why don't I get one that hasn't gone down yet? Have you ever made that mistake?
Oh, yes, very much so. Find the ones that haven't yet caught up and are overperforming, because the idea is that, maybe they'll catch up to the pack. And right?
Yeah. I always like to boil trading down to the most basic premise. There's only one reason that a stock will go up: that there's more buyers than sellers. There's a million reasons why people buy and sell stocks every day. There's a million reasons why on any given day Tesla people are in there buying and selling. We'll never know all those reasons. But we do know that if Tesla went up today, it was because there was more buyers than sellers today. We know that for a fact. So if you want to make money in trading, you're not trying to figure out anything about Tesla other than, is there going to be more buyers or sellers tomorrow? If that is true and you buy it today and sell it tomorrow, you're going to make money. We use a lot of things in trading to try to figure out what the supply and demand imbalance is going to be. We use charts, we use moving averages, we have stochastics, MACDs, we use all these things. But to boil it down, very simply, you are simply trying to find supply and demand imbalances. So go back to our example. If you're trying to find supply and demand imbalances, and you look in the semiconductor sector, and there's one that has a big supply imbalance to where it's selling off because there's so many sellers and not any buyers, versus the one that right now there's an equal amount of buyers and sellers, and you go short, it can always reverse. Things can always change tomorrow. But you at least are starting the trade in the right spot. But if you choose a semiconductor stock that's actually going up right now, you're hoping and praying that that supply and demand picture turns around before you get stopped out. You are fighting against the wind. That's why it's just so important. Price action, so important, and we're just big believers in relative strength and weakness.
Going back to your earlier years, did you ever find that when you spent a lot of time, say, researching particular stock to go long or short, and I don't know if you looked at fundamentals or whatever, and then you thought that, oh, I've really picked out this gem to go long or short, did that impact your decision to sell because of the time that you invested researching? Yes.
And that was the absolute beauty of the Flat Earth Trading Society. Talk about not having any stake in a position. If you chose your position based on the Scrabble tiles that you turned over on your desk, and then it approached your stop, and you say, I know I'm right on this one. You would never say that. You would never, it would be the most ridiculous thing that you've ever had in your brain to be like, oh, I know the Scrabble tiles aren't going to lead me wrong, or the Ouija board spirits. You would just get out. You would just get out because you've got nothing attaching yourself. The more research you do will actually hurt you in a trade. And we tell this to our traders all the time. Look, you've got to do enough research to where you're not just guessing. But too much, you're actually now making your position management a lot harder. Because imagine if I remember listening to conference calls after earnings reports as a young trader. And, you'd listen to all the people, all the directors and CEOs on the conference calls, and they'd say, we really like where it is. And you're like, oh, I like how that guy talks. He's really cool. I think he's right. I think the stock's going to go up. And then tomorrow the stock doesn't go up. I'm going to have a hard time getting out of that. Why? Because I had a favorable opinion of the CEO on a conference call who maybe wasn't even telling the truth. Who knows? But remember, the game I'm trying to win is, what's the supply and demand imbalance? Who cares what they said on the conference call? I love to boil trading down to that very simple premise. Where is the supply and demand imbalance?
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So what did you like best about this experiment overall?
The thing I liked best at the end of it were the comments. I had people that stuck with me for an entire year, cheering me on and being like, hey, thank you for sticking with this. I didn't think you were going to do all 100, but hey, good job, And the best thing is the comments on my last video. People said that this got them over the hump to where they're now profitable traders. And they said, it took this experiment for me to realize that I was the reason I wasn't profitable. And they took themselves out of the exit. They removed themselves from the equation, and they went to a systematic method of trading, and it got them over the hump.
Wow, fantastic.
That was the whole point. I wanted the data. Remember, I started out telling the story about those two traders? That's just a story. I want the data to where in 5 years, in 10 years, in 15 years, 20 years, traders are going to come across this. And it's still going to be relevant to show consistency beats intelligence every single time. And that's what hopefully the goal and the purpose of this experiment and what I achieved at the end of it. It doesn't matter that it made 15%. Who cares about it? It doesn't matter that it delivered a 2-to-1 risk reward. Like that, those numbers could have been randomly different across any 100 trades we did. But the fact that it was profitable, then people can now add on their entry strategies and become more profitable.
Wow, fantastic. So could you review again the experiment takeaways?
Well, let's just go over the numbers. 15% return, 40% win-loss. I had a question on one of the videos saying, well, Rob, why isn't this a 50-50? If it's random, why isn't it 50-50? Well, it's because of the stop. If we had no stop, then it should be around 50-50. It should be around that number. But the fact that you have a stop means that some of the trades that, go up a little bit. So with a trailing stop, if a trade goes up 1 ATR and then pulls back 2 ATR, it gets stopped out. But instead of being $1,000 loss, it was a $500 loss. So that trailing stop is going to chip away some of your stocks that potentially could have been winners, if that makes sense. Because if you just kept your stop at 2x ATR, even though it had that big pullback, it could have reversed and gone much higher. But the fact you had that trailing stop, it's going to get a couple of those stocks that just had big pullbacks, but didn't, would have gone much higher. So again, 40% win-loss, profit factor 1.38, risk reward 2-to-1. Those are just the numbers, but really wanted to show that just methodical trading over and over again, doing the same thing. And I was really happy I had some of our traders at Maverick help me out, because we did updates every time a trade was stopped out or every time we did an adjustment. We did a live update to show this all when it was happening. So I was really happy to have some staff help me, because it got to be a bigger job than I expected at first. But at the end of it all, the results came out good. Do not think that this is the holy grail, that you can just take what the Flat Earth Trading Society did and that's going to make you a great trader. That's not the point of this experiment. Figure out your own position management strategy. Back test it, demo trade test it, test with some money, and craft it to where it really works for you. One of the first things we have our traders do is they take a trading personality test. It's based on Myers-Briggs, and they take the test, basically ask you some trading questions and gives you what should be your Myers-Briggs score. And we talk about, this is who you are. You cannot change who you are. I am an extrovert. I'm a very extroverted person. So if you took the test and you came in as a big extrovert, I can already tell you before you start trading that you're going to have problems with overtrading. You're going to have problems with over position sizing. I can already tell you the problems you're going to have based on your personality. If you're an introvert, if you're a strong introvert, you're going to be an undertrader. You're going to miss out on a whole bunch of trades. You're going to chicken out a lot. I can already tell you. So when you do build your system, you can't build a system that doesn't work for who you are as a person. So I really highly recommend, we do have a trading personality website out there. If you want to put it in, great. If not, look, just take a Myers-Briggs test. But we talk about the strengths and weaknesses in trading of all of the personality types and what it means to you. You can either be a judger or a perceptive person. A judger see the world in black and white. So when they go out and trading, it's either a win or a loss. It was either right or wrong. That sets you up with such a difficult psychological challenge because you equate win with good, loss with bad. And you have a very hard time accepting that this is just an odds game. That you're just flipping a coin 100 times and you're going to try to be heads on more than you were tails on. People with a very strong J, they have a very difficult time understanding this because right or wrong, good or bad, it's just very difficult for them. So we go through a lot of those things in the trader personality test.
Interesting. Yeah, the Briggs-Myers test, as I remember, has 16 different possible combination of personalities. So that's quite. I imagine that's quite insightful. Your description of the introverted trading definitely fits me. So I resonate with that.
Yep. Well, look, and this is where you've probably beat yourself up for it over the years.
Oh yeah, definitely.
Guess what? You can't change it. Just stop beating yourself up. Stop beating yourself up because this is who you are. So embrace it, love it, accept it, and say, how can I trade in spite of this? And that's when you get over the hump as a trader to where you're no longer fighting your battles. You're just building and planning and perfecting systems. And that's all you're doing. You're just trying to find systems that work. You've overcome everything that you know you're not good at.
Fantastic, Rob. We'll be sharing Rob's links to this experiment in the show notes. Rob, thanks for coming on Chat with Traders.
You bet. Thanks for having me.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Oh, 100%. They have all the tools. They have all the advantages, right? Mm-hmm. So that's why I always tell myself, I only need to jump on that trend once a day. And as long as I'm on that trend once a day and try to pick up that one impulsive move that's good enough for me. I don't need to pick up like the entire move of the day. I don't need to pick up all 5 impulses of the day because I know I don't have all the information, like you said, like the institutions, the banks. The algorithm is the one that dictates the momentum shifts of the day. So it's all about capital preservation because you never know when the momentum is going to shift.
Markets, speculation, and risk. This is the Chat with Traders podcast.
And we meet again on Chat with Traders, episode 288. It's Tessa, your co-host, and today Ian speaks with Steve B., a professional independent trader that I consider to be a good friend who we got to know organically through the Chat with Traders community when we were open and active at the time. And as some of you know, Steve teamed up with our community mentor at the time, Patrick Peterson, who we also interviewed on episode 260. Together, they ran the Chat with Traders community live trading room. It was started because it was driven by a group of members' desire to learn from their trading approach and strategies. And though their styles differ from each other, Patrick and Steve, their shared trading work ethic and passion for the markets was a strong force in the community that was an inspiration to many of our members. And they traded mainly futures on the major indices. And Steve is known to be a confluence intraday trader, which you'll get an understanding of what that is for him in a moment. I just remember many of our members were very interested in their trading approach. And in fact, some switched over from trading stocks or Forex to trading futures. And one of the things I remember about their charts was that the charts were very minimalistic with just a few things on it. But I remember specifically that they had these lines representing key levels that were important to them. And I'm not talking about ordinary support and resistance lines that you interpret and draw out yourself. These were different, at least to me at the time. These were lines derived from the data from the options market that helped build their roadmap. And it was part of their daily routine every morning before trading. But did you catch something? Why are these traders who don't trade options using options data for their trading when trading futures? Well, perhaps you'll be able to connect some of the dots in this chat and gain some new insights from what Steve has to share with us today and his journey. Steve's been in the markets for about 10 years now, and I'm so drawn to his practical attitude towards trading and how he sees trading as an income stream to feed into building his wealth, with the end goal, of course, to having more freedom, both financially and time-wise, to really enjoy his family, friends, and life. So we hope you enjoyed this episode. Happy listening. Ladies and gentlemen, we're so pleased to introduce Steve B. from Calgary, Canada.
Welcome to Chat with Traders, or actually, maybe I should say welcome back to Chat with Traders, because you've been an active member in the Chat with Traders community.
Thanks again, Ian and Tessa. And it's my great pleasure to be here and have this interview with you.
Yeah. So where are you?
So currently right now I'm out west, or I should say northwest in Calgary, Canada. I'm up north. That's where I was born and raised, and that's where I currently am located right now. So.
Let's get into your background, things you studied in school and your early interests.
So I'm first generation Canadian. I was brought up by a European family, immigrated from Eastern Europe to Canada. And of course, they taught me the traditional way was to always work hard in school, stay busy in athletics, always be busy with different kind of sports all across, from basketball, soccer, and tennis. And later continue my studies in post-secondary college. So very traditional family from Europe. And of course, I went towards that direction and ended up finishing a bachelor's degree in business with a minor in finance and a major in accounting, actually. That was my background there, which I would say definitely helped with my foundation and understanding just the function of businesses and how they work from A to Z. That's how I was brought up. And with the trading side, I would say later in my college years was the time when I opened up my first equity trading account with TD Bank here in Canada. And this was early entry into investing and definitely allowed me to develop like a deeper understanding of financial markets, and especially into that deep pain that we all go through of losing and accepting that loss So yeah, but I definitely learned that early on. But we can definitely go into that later and explain how important it was to endure those losses. So sorry, let me rephrase. Endure those small losses, Ian,
Uh-huh.
all throughout my career, small enough, in order to build those larger wins later on. And then after college, of course, went into my first few jobs, worked up the traditional corporate ladder, and slowly with various accounting roles, also consulting roles, I was able to gain some invaluable experience, of course, to the workforce. And I think one was very important was discipline and having those daily routines that I find very important in trading as well. Just always being, what time to wake up, understanding your meetings and what time to leave and get home. So just that day-to-day priority, I thought that was very important.
How many years ago did you open up your first investment/trading account?
Yeah, so that was over 10 years. So it's been about 10, 11 years since I opened my first broker account.
So given that you come from an accounting type background, a business type background, what were you looking at when you would buy a stock? Were you look at fundamentals? Kind of what were the criteria for you to buy a stock?
Yeah, so in the beginning, it was all about I was looking for those sectors that had good discounts. I always looked at those major sectors across the board, which have been selling off for a while. I tried to get in early, looked into fundamentals. And of course, I tried to look into more so like the medium to like larger cap stocks. And yeah, whatever was giving me good discounts that wasn't really trending, we were at good discounts for a few years, and I would buy those up and just kind of wait for the rally and like the buy side to start to set in. So that was kind of my understanding and my strategy early on with stocks.
Would you consider yourself at that time more of a value investor?
Yeah, more of a value investor. Just picking out, like if oil and gas was, because oil and gas, that was their specialty where I was from. So if that was, had a few down years and, the price of oil was down near like $50-$60 per barrel, then yeah, I would just pick up the strong stocks, average down and just hold them for a few years. So that was definitely my strategy longer term in the beginning.
Yeah, definitely had some patience there to hold on for quite a bit of time, right?
Yes, exactly. Yeah.
Until you come to fruition. So you stuck with stocks for some time?
Yeah, stuck with stocks. I felt that my capital was definitely a lot safer in the traditional banks. And well, of course, with the traditional banks, once you open the brokers, yeah, like your main assets are either mutual funds where you let the banks do the investing for you and they just pay you out 3-4% dividends. But of course, I want to master the skill myself. So just whatever stocks were available, I started investing in. And yeah, it was very long term. It was in the beginning because at the time I was busy with college as well, studying. And then once I got into the workforce, I was always, of course, I had to like learn the procedures and everything going on. So I was always busy with other things in that sense. So I didn't have time to day trade or anything in that sense early on.
And how did you like your career?
Career was fine. Of course, I eventually was having issues with, not issues so much, but just the time it took to climb that ladder was too long for me. And I saw my parents go through it and some family friends and how it took, 10, 15 years to reach that seniority. And of course, and also came with taking your master's or it could be a CFA or CPA in accounting, which I didn't mind either, going through more education. But the time it took started to deteriorate for me, and it was just too much when I had other plans. I was always an entrepreneur at heart, so I felt there was another path for me, and I guess that's kind of how I started the next path of my life, because it was just taking time away from me after being in there for 7-8 years. I was able to save enough money to create a different path for myself.
I see. So when did you think that investing or trading could actually become your primary source of what you do?
Yeah, so I had to create a template for myself and a strategy, of course. Start building a clientele while I was working full time, as well as reserve capital, because of course, I was married, I had a family. I would never advise taking that leap without having the right amount of capital, as well as like a template, a strategy of how to continuously start earning revenue for your company. So yeah, that was the main part it took away. And of course, understanding the full steps of a business and how it works, not only from the sales side, but the accounting side and the back end as well. And that's something I was able to learn during my time on the corporate end was the accounting, and truly how the assets and liabilities mesh together, and how to correctly build your inventory. So in that sense, as a trader, your inventory is your capital, and how to precisely manage that going forward.
Uh-huh. Interesting. So you took what you learned on the job and through school as a way to to how you allocated your capital between different businesses and how much
Yeah.
cash you kept on hand and what have you?
Yeah, exactly. And like I always had a natural feel towards business as well as a young age. I was always drawn to like the sales side, the economics, and always like data driven decisions as well. So like even in the early years of high school, I was taking business related courses. So I was always already familiar myself like with sales and marketing and accounting early on in high school. So that definitely like started fueling my curiosity about the financial markets. And I feel like that early exposure definitely helped me kind of just tunnel vision into something that I enjoyed as a profession. And I wasn't forced into anything else. Because I feel like that's the issue as well. A lot of people early on is they waste away so many years on something they don't enjoy. I feel like eventually it could be too late to start something new. So luckily, I found that profession I enjoyed early on and stuck with it.
When did you make the decision that you want to quit your job and go into trading full time?
Yeah, so that was definitely, it took some time. But the decision to leave my job was definitely, there was a few factors there, I would say first before when. Primarily was when I was just having too many constraints with the overhead, with just too much management above me, like too much resistance, as you'd say in the markets, just above me, market structure, or sorry, management structures, and just too many policies limiting my time. That's the biggest thing. I always value is time, and just working under all those layers of management made it difficult to pursue just my personal ideas and business ventures. So I realized that in order to truly pursue the greater business goals, I needed that freedom to take control of my professional direction, where I want to head. So yeah, a significant aspect of the decision was definitely a desire to reclaim my time, because definitely a lot of time was being taken away from me. And I started to realize that later, like later in my 20s and my late 20s, I started to realize that as I grew older and had a wife and started, building a family and got married. So I just wanted that flexibility to create my own schedule, allowing myself to focus on only ventures, and also just the business development and work balance. So this transition has provided me with opportunity to build something while also maintaining the freedom to prioritize what truly mattered to me. Because I feel like when I had the 9 to 5, I wasn't able to prioritize too much what really mattered to me. More so just making that income, being done at Friday, and then just focusing on the weekend. Where so now I actually can't wait for Monday. I'm excited for Monday to occur, which is crazy. I want the market to open. So I'm like the opposite. So kind of how Patrick would always say in our community, and we always work side to side. We're waiting for that Monday open. Like I want the weekend to be over, which is nice to relax, of course. But once that Monday comes, I can't get any more excited. So it's funny how the script has flipped into that. Now that I'm on my own now instead of through the 9 to 5. So
Yeah. So when you say that you couldn't wait for Monday to open, that seems to imply that you wanted to make more kind of shorter term trading rather than the long term buy and hold, because the excitement of the new day of trading opening up, creating opportunities. Did you switch from a long term buy and hold investor to more shorter term?
So I have a mix of both. Of course, I'll always have my long-term investments, but the one way where I earn income and my revenue is now from my day-to-day trading. And majority of the time, I am closing those days by day's end as well, to just kind of free myself from the market, not having to check the charts, not having to stress about it. Because I feel like, especially when you use leverage, it's a different story comparatively to stocks. With stocks, there's no leverage. You buy and hold for a long time. There's less likely of you entering any sort of like margin call or whatnot. I'm not saying I use that much margin. I always stick to the 1% rule, of course, per day. But you just never have that risk of gapping and margin and leverage. So with stocks, there's a lot more flexibility and less stress. But with my day to day, my goal is always to close by day's end. So.
Were you ever seduced by the videos on YouTube of traders showing the new Lamborghini that they bought?
Oh, 100%. We all went through it, Ian. We all, sometimes even now, of course, through my experience, I look at it And I'm like, oh, it must be nice driving a Lamborghini, because I would like to drive a Lamborghini. Who wouldn't? Right. But of course, when we look at it, and yeah, I can get into this, it's all an illusion, right? It's rented items, rented houses, a rented lifestyle, whether it's on a boat in Miami. But then again, it's not a bad business idea either, because if you lure in clients and make money, that's a business venture right there as well, right? Yeah, I'm not saying it's very truthful or ethical, but that works. But that's never. I promise you, Ian. I promise you, and Tessa and Patrick as well. I'll never go down that road. I promise you'll never see me flaunting a Lamborghini. So yeah, but yeah, of course, when I first started trading, most of my early moves were like invested orientated. But I feel like one of my biggest mistakes, especially early on, was watching these YouTubers trading the penny stocks, trading over the counter, low float stocks that could 100x your account, right? You bought them at pennies and they flipped to $1. Like, we've all seen it before, but I feel like that was definitely one of the biggest mistakes I made.
Oh, why is that? Share with us.
Yeah, so yeah, I was watching a couple of videos and just seeing some of these guys post their 10, 20, 100x returns in the OTC markets, penny stocks, because you get the adrenaline going, you get the hype. You want that 100x gain, right? You put in $1,000. Why not, right? To make 100 grand off 1,000, that's everyone's dream. But that was definitely one of my biggest mistakes, because it was more about the excitement and more about being a part of that community, even though it was the wrong community. But we can get into that later about community and how important that is. But I just started chasing these opportunities, hoping to replicate their success, even though who knows if it was real or not, because they can always manipulate the book. But I learned quickly that those trades were far riskier than anticipated. Penny stocks, of course, are notorious for volatility and lack of liquidity as well. So just the chances of making consistent gains were very slim. So they were offering high risk and almost no reward. So that was the issue there. And yeah, since the reward was almost zero, I learned my big mistake. And once those mistakes come in and you see red in your account and they keep dwindling down, yeah, that was a big life lesson. So that's definitely like I would say one of those big life lessons I never go back to. Never touch penny stocks ever again. Ian. Learn my lessons. But then again, maybe it was good that I entered that market, because I would never have the memory of having that loss, right? So let's say I'm at the current stage right now, and I never entered the penny stocks or the OTC, and I have some friends, some community members talking about it, and maybe now I'll dip into that market, not realizing that low reward, high risk. So I feel like it was a good thing I went through that when I was young, risked a lot of capital, lost the capital, and never again. So definitely taught me the importance of developing my own strategy and not following anyone else on YouTube, focusing on risk management and just avoiding the temptation of like a quick fix solution. So I found that just very important for myself.
After the penny stock experience, what did you develop then? Like, what did you get into to trade?
Yeah, of course. Yeah. So yeah, the next step was developing a process. And that's when I saw the opportunity from the day-to-day trading. I can go later on what I was trading, but first with the process, the journey of developing a solid process began with just an intense focus on data and understanding the underlying reason of why the market's moving. The market's not moving because of candlesticks. No, that's just a presentation of movement, because you can draw a line chart, a graph chart, and a candlestick. Like, the candlesticks is not why the market moves. So I wanted a deeper feeling of seeing like what is going on and realizing just like in the markets, just like a deeper understanding of like the mechanics of price action. And this meant studying the macro events to prepare for volatility spikes, as well as how these institutional players move within the markets. So I had to understand this first. So, markets are very fluid, always evolving. And I found that momentum shifts can happen at any time at key points, not only at the hourly close. So the unpredictability made it challenging to always rely on chart patterns on the 1 minute or 5 minute, as well as like increasing imbalances in candles. So beyond the price patterns, I found it was important to not only like look at the volatility that we get on the VIX and the DXY, but also like the order flow and other external factors. I felt was like very important. So yeah, in this process, of course, came a lot of mistakes, and I had to continually adapt. So incorporating risk management strategies, I felt like was first and most important, because no single approach will work without this strategy. So by focusing on the broader market and looking at the momentum shifts rather than predicting them, I was able to redefine my process to something more resilient and reliable. So,
are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
one of the main factors that I was able to gain an edge was my checklist. And it's similar, I would say, to an if statement in the, let's say, Excel spreadsheet. So if, let's say, a few checks did not clear in the morning, my bias would change. And the setup could also change into another idea later in the trading hour. So my process was based on time, volatility, and data. And then if I didn't get all my checks, that bias or that setup would be crossed off, and then it would start forming into another idea, maybe later on in the day. So that was my if statement on my checklist. So ultimately, developing the process wasn't about finding like a magic formula. It was more about continuous learning and just execution based on time and the probability of various scenarios. So
while you're doing this day trading, you also have your long-term buy and hold investments. Is that correct?
Yes, that's correct. Yeah.
Okay. And then so when you do the day trading, were you focused on specific stocks or indices? I mean, like what did you trade?
Since my trades were on the shorter term, I would say 95% of the time I'm closing my positions end of day, right? So if I'm closing my positions end of day, I need leverage. I need a good amount of margin, and I need to be trading markets with, of course, large amounts of volume, data, and the smallest amount of slippage. So, of course, these two assets are the S&P and NASDAQ, clean and simple.
Uh-huh.
So these assets were always also aligned with like the location and time frame for also where I'm living in North America. I was always going to get volatility once New York hit. So it definitely made it much easier to wake up in the mornings, prepare myself for that New York volatility, and also close my book later on, especially my time, mountain time during lunchtime, and just be able to enjoy my day with my family and friends later on. So just clean and simple, gave me the freedom to trade and not have to worry about like the London session and Asian session as well in the Forex market.
So let's go into your checklist. What are the items in your checklist?
With my checklist, because I'm always looking at data, volume, and exposure, things I always look for is because whatever happened in the previous day, it doesn't matter as much. Unless sometimes I would look at, let's say, the daily pivot, the weekly pivot, just to look at a more macro, zoomed out outlook. But usually whatever happened the previous day doesn't really affect me, because anything can happen during pre-market and during like the momentum can shift at any time. So the first thing I look at is where are the largest areas of supply and demand, or in the options market, we would say exposure. So I look at these levels and I put them on my chart. Put it clean and simple. Okay, so where is price? So my first checklist is where is New York opening? Or sorry, where is the pre-market opening? And where is, like, let's say 30 minutes after going to be opening as well on my checklist? Is it like in bullish or bearish territory with exposure and volume? And then second on my checklist is, does the risk and reward make sense? Because if the risk makes sense, but the reward where price I would start taking profit doesn't make sense, then the trade is invalidated. Both ends have to make sense. Give me at least a nice 2 to 3 to 1, even 4 to 1 risk reward, because of course we're not going to be winning every trade. It has to be higher reward than risk at the time. And yeah, if the both ends are not making sense, then it's invalidated as well. And I would say a third checklist would definitely be my my confluence, because I'm a confluence trader. So if I'm trading the NASDAQ, I like to bring up the VIX, I like to bring up the DXY, and I like to bring up the options market, and let's say the Magnificent Seven. The top 7 stocks, what are they doing, especially the tech stocks, and how are they correlating? How are they responding? Because a lot of times if they're responding, let's say 50-50 divergence, that could also play a part in NASDAQ. Or if they're all moving the same way with the same amount of volume, that could also create an idea for NASDAQ as well. So those are 3 of the main checklists I look at. What are the Mag 7 doing, and and on my other confluences? And once they react to the certain zones, when I set the alerts, where is NASDAQ and how is NASDAQ reacting at the certain level? So that's how
I see. So you're trading what, both NASDAQ futures and S&P futures, or just the
Yes, that's
ETF?
correct. Yeah. That's correct. Yeah. The futures, as well as I have a couple like CFD brokers as well, because they give me better margin. And it's also like I enjoy using their risk tools, because that's usually the only indicators and tools I use is the risk parameters, because volatility every day is going to be different. And one good way to look at it is the VIX, right? Like today, for example, we have a good example how we had a Fed speaker, Jerome Powell. And once he started speaking, we had a huge increase in volatility. So of course, how I'm measuring risk is going to be converted into dollar form is going to be much different than yesterday, because the volatility is much different. I'm always risking the same amount in dollar form or percentage form, let's say 1% per day. But the moves are going to be much greater today than they were yesterday, because we had Jerome Powell speaking. So that's why I'm always looking as well, to protect myself, not entering the same amount of lots or the same amount of contracts per se as the other day.
Oh, I see. So depending on how you assess the risk at that moment, you will size your position accordingly.
That's correct. Yeah. So that's another important key factor in my checklist is first wait for that volatility spike, measure the risk, and always have the same amount in dollar form every day, because I feel like that's important. And that's how a lot of traders blow out, because they don't realize that every day is different. Sometimes you're going to have like low ranging choppy days, and other days you're going to have Jerome Powell speaking and completely take you out, because you're thinking, oh, I put on 5 contracts the other day and I was fine, I was safe, but 5 contracts today is going to be offering a lot different like risk exposure for your trading and for your risk managing. Because at the end of the day, Ian, I find the term trader misleading, and it should be more of a risk manager, because you're managing your portfolio, you're managing your equity in dollar form. So you should be a risk manager more so than a trader. So that's why I always look at it.
So okay, so say you let's dive into the process even deeper. So say you look at the NASDAQ before the market opens, or the S&P, and you notice that it's hovering down near support levels, and the support levels appear to be decent. What are you doing? Are you then looking also at these top 7 stocks to see their movement, and if they are in alignment with a possible, say, bullish move to the upside? Does their representation and how they move individually influence whether you go long and the size of how much you go long?
I would say it's more so of an average of the 7. I like to look at where the average of the 7 is going. And if they start increasing their exposure or start heading towards these, let's say, institutional levels that I draw on my charts, and how they're responding to it relative to NASDAQ. So if they're painting a completely different picture than S&P and NASDAQ, then I like to be patient and wait, because a lot of times the movements can be a little delayed when compared to the indices. like we can also go into like how I'm trading, whether I'm trading indicators or whatnot. Because for me, I like to stay away from the indicators. I've learned
Why
my
is that?
lesson.
Uh-huh.
So for me, they just make my charts a little too messy because already I have my risk drawing tools, my that are calculated on my brokers, as well as my levels that I create from data. So that's why I like to take away the indicators. Probably the only time you'll see an indicator is when I am trailing my position. I like to trail it either on the ATR or the SMA when I'm just closely trailing it and about to close out my position. It's probably the only time I'll use an indicator because, of course, they're all delayed based on candlesticks. And for me, before making a decision to enter a market, I was never in the past. In the past, I was never be able to gain an edge on candlesticks alone, especially when I'm trading on the shorter term. On the shorter term, intraday. Swing trading, of course, is much different. You have a lot more data, you have a lot more time. You don't have to be as precise, but because I have to be a little more precise, I cannot be trading on the candlesticks, right? Because all those coded metrics are all calculated on past performing price action. So any script you create or readjust to your liking can be looked at as an illusion, right, of past performance and will never lead to consistent future results. So I've been there. I've coded on PineScript and TradingView. I've tried to give myself the highest earning profit factor, and I've tested, readjusted, looked back at the script in real time, and just to readjust that P&L. And then always, when I would start forward testing, my profit factor and my P&L would always go down because past performance. Because when you're coding these strategies on TradingView, it's an illusion because you always try and get yourself the best profit factor, right? But past results are never going to copy onto the future, especially on day-to-day structure, because every day is different, especially when different like newsprints coming out and like momentum shift with the rates and whatnot going on. Once Jerome Powell starts speaking about like economics and job reports and whatnot. So yeah, it's the profit factor would always diminish. And I learned the hard way. I still had to test it out to see if I was able to code something for myself intraday, but with my profit factor always going downhill, diminishing, it just never worked out. So anyways, I learned a large lesson, but it was a good one. And I wouldn't give up on the edge. So that's why I always started studying live volume and entered the world of options exposure and dealer positioning. This is where I gained the edge. This is where I started to kind of realize the cycles of markets per day, per week, and where and why price movement usually likes to magnetize towards a certain area, a certain level. It would kind of make sense. So, and for my day-to-day, I didn't have to pick out the best entries. I didn't have to be as precise, but instead I always tried to spot the trend and pick off that one major move of each day. That's all that mattered. Whether we had 3 or 4 major moves, I only needed one for the day, and that was good enough for me. So with the option flow and dealer positioning, whether it was pre-market during futures or 15, 30 minutes after New York, which I like to wait if I didn't get a setup beforehand, I was able to find that major impulse. And once I am able to find that trend and that major impulse, once you see the institutional volume start kicking in, that was good enough for me. So all that was needed for me is to identify one major trend, and that was enough to steer away from overtrading as well. Close my book and be done for the day. So
I see. And how do you mentioned prices gravitating towards certain levels and institutional involvement. How do you measure that? Like, go into detail on how that works.
Yeah. So of course, there's a couple of platforms you can go online to gather this information from the options market. So they're just large exposure levels. So you can also mix this in with high volume levels or time and sales that entered in the past, but you want to also forward test and use live data as well. And every day it's recalculated. So yeah, I would implement these institutional levels onto my charts every day since it's recalculated, and just wait for price to start entering these zones. And that's when I look at the live volume. So once they enter these institutional zones, right? So these zones, these levels are there for market makers to identify the high exposure, whether they have to start hedging, or let's say the level starts rejecting, then they don't have to hedge anymore. So kind of these squeeze zones. Now I'd always look at the live volume and see how price is reacting on those important levels. So it also helped me not to overtrade because I just be patient, set my alert. And once like either the MIX 7 or NASDAQ or S&P start entering these levels, even the VIX has some option flow as well. I was able to just stay patient and wait for the market to show its hand, if it's getting rejected or if it's going to start squeezing through to the next level. So that's how I'm always able to trade. So
describe squeezing to the next level. You mentioned market makers and volume. I mean, you're talking about the options market here.
Yeah, so the options market, when you look at NASDAQ, S&P, of course, that's SPY and QQQ, but end of the day, it's the same chart as futures and CFDs. It's all the same chart, but you're looking at different sides of volume exposure. So this is, and we all know as well that institutions use the options market to start to hedge their positions as well. So the institutions, right, they have, if they're positioned in NASDAQ, they have positions in the futures market, they have position in the stock market, and then they use the options market to hedge. So, what's happening in the options market is you have those dealer positions in certain important areas, and they always have to match the buys and the sells in certain areas, right? So that's why I always stay away from like the 50% range between the two levels as well, because you have a lot of chip chop, and that always helps, because once it reaches that level and I look at volume, it gives me a higher probability setup, whether it's going to take it to the next level above or get rejected and sell down below. So this is, because at the end of the day, we're all small fish in the sea. We have no influence in the market. So therefore, I'm never trying to beat the market, Ian, right? I'm never trying to beat it. And my whole purpose is just to catch that one small move of the day that gives me that high probability setup and just be on the right side of the trend. That's all I'm looking for. I don't have to be so precise to the very tick. And for when the time comes, I just capitalize, put in my risk. And if the risk reward makes sense on both ends, I take the trade and be done with it. So usually 1 to 2 trades a day, but I like to minimize it to just 1 trade a day.
So you mentioned volume. Are you talking volume of the underlying or volume of the options?
So just the live volume, I usually buy this through the options, through the futures market. Sorry. So I look at the delta. I look at how I sometimes look at the footprint, how each, let's say, candlestick, whether comparing the 2 candlesticks, which traded on more volume, whether which is stronger, the buy side or the sell side pressure on that zone. But I don't mess around in between what's happening, the volatility, the chip chop. I just wait until it hits my zone, hits my institutional level, and then I make a decision based on like the live volume.
So when you say when it hits the level, are you talking about levels of strong support, say where they've sold many puts, or areas of resistance where there's a lot of concentrated call open interest at certain key levels? Are you looking for it to break one of these congested levels?
Yeah, so these are like call put gamma exposures. So gamma as well as delta exposures. And then I always look for the highest exposed levels for the day. So because they're always recalculated by end of day and then in the morning right before New York. So I always look for these areas because these are obviously important areas. The market makers are increasing the exposure because there's a reason behind it. There's always a story behind it. So that's why I'm able to be a little patient on it. But I'm not looking so much as like the live option market. I'm not looking, because when you see a big order in the options market, whether it's a call or a put, just because it's a large call, let's say above ask or below bid, you can't really decipher whether it's a long or short, because it can easily be a hedge and be wanting to go the other direction. That's why I just focus on the exposure levels, the story behind it, and where it's placed during New York. And then I look into the live volume on the futures end and line that up with my confluences. And of course, I have to be quick as well, because sometimes the move can happen very fast. But I've been in the markets long enough where I can kind of decipher what's going on, set my checklist, set my risk, which is most important, like I said, on both ends, if they make sense. And I just let the trade play out.
I see. So it sounds like you're kind of juggling a bunch of different areas that you're looking at simultaneously, right? You're looking at the VIX, you're looking at support and resistance on the NASDAQ or whatever, S&P, and you're looking at also support and resistance of key areas where a lot of option open interest is concentrated. Is that correct?
That's correct, yes.
And then, so what happens if if it starts to go above the area of quote resistance on the call side and it starts moving up? Who care? I mean, what is this gamma exposure, and why should we care?
Yeah, so the reason we should care is because if it starts squeezing and the market makers need to start hedging and the institutions start hedging, then the move can be very fast. It can be rapid. So
to the upside.
To the upside. So this could also bring in a new strategy where you can start hedging. I wouldn't advise, especially any beginners, to start hedging, because at the end of the day, you need capital and you need margin, right? If you're risking low enough where you have plenty of margin to work with to start hedging and know where you're hedging to, and you're watching the live data, either in the options market in the futures, then it can make sense. But at the end of the day, I feel like if it's rapidly moving against you, it's probably a good time to just close it and call it a day. Because if your risk reward, if your probability is always more than 2 to 3 to 1, why risk the hedge and just be out for the day and just close the book, in my opinion? Because I just find it so important to learn from these losses. You sometimes need to embrace these losses. That's the thing. Because each loss becomes like a data point into your memory, into your journey. And it should just be a data point rather than something personal, right? You should never be emotionally attached to that outcome. So sometimes, like I said, if it's rapidly going against you, just close it, be done, journal it, and see how you can better your probability or risk reward. But then again, also remember that you can't always be right, and be happy for the loss. Be happy for the loss, or that small loss. Comparatively, it could have been a much greater loss. Because once price starts rapidly moving the other direction, it's better to just close it and be done with it. Because that's another important thing. When people journal, they should look at the timing of their losses and their wins. And if the time of your losses are much greater, that's an issue as well. You always want to cut them a lot earlier.
When you look at support and resistance areas, do you ever enter an order, like a buy stop order, to buy once it crosses above that resistance area, and or putting in a stop loss? Do you use either of those?
Yeah, so I always use stop loss because the market can turn anytime. You could go out for a coffee. Anything can happen with your life. You always need to protect yourself. Even though, I know I've caught myself a few times not putting a stop, even though my stop was well above that position where I didn't have to, stress too much about it. But of course, I advise everyone to always put a stop loss. You never know what's going to go on. Maybe you forget that there's some big volatility event coming up, right? Either Jerome Powell speaking, or we have CPI, NFP, and you completely forgot about that news, and you let on a trade without a stop loss. That's that could put yourself in danger, right? Whether you're trading your own capital or prop firm capital, always put in the stop just in case, and always measure it where it's in an area where it makes sense for it to get stopped out. If it reaches that area, then your bias is completely invalidated. That's important as well. Because the market can go either which direction, right? Never. That's why I said before, never get emotionally attached. Always stay grounded, and then kind of embrace that loss as well. But where it's small enough that you gain further knowledge and then come back much bigger. So I think that's always important. So you leave enough margin and enough capital for the future. So be out of that trade, close the book, or if you see another setup, make sure you risk less. So it's always about surviving into the future, into the next day. I find that to be very important.
What do you do for position sizing? Do you just, you say you bet the same amount each time, or same?
Yeah, so I have a position sizer calculator on my brokers. And then I always make sure I wait for the volatility to kick in, and then I measure based on the volatility. And I always convert it into dollar form or percentage form. Let's say 1% of your capital and then to dollar form. So it's always the same amount. Never try and bid more sizing, especially on a crazy day like today where we had chop. Jay Powell came on, we went up 100 points, and then we sold off 200 points. It's no, don't. That's when you'll be humbled very quickly right? It's the market, the market will sit you down on your ass very quickly and try and reassess it. So I always try to keep it the same every day, keep it consistent, because I don't like to stray away from any crazy ideas, because one explosive idea can really put you back a few steps. I always try and go forward 5 steps and sometimes 1 step back and create that momentum forward, like the S&P. You zoom out on the S&P on the weekly, on the monthly, it's slowly trending up. I try to have my profile at the same chart as S&P, slowly grinding up, not having crazy volatile turns. Of course, you're going to have a black swan event here and there, but as long as you're not risking too much of your capital. So
why do you think more traders are using options data when trading futures?
It's a good way to, I feel like you said, with support and resistance, because what is support and resistance, or what's a good area of support? It's when the supply and demand is usually equal. If price settles in a strong area, it means the buyers and the sellers are the same. Price hasn't moved out from that area, right? And then what happens when there's an imbalance is that when the price either shoots up or shoots down from that area, there's a greater demand or greater supply. So what the options market does, it creates these exposure levels, and it can a lot of time maybe align with your supply and demand as well. So if you link up those strong supply and demand zones, with the options market, that could create like an extra confluence as well. So I always needed more confluence. I could never just base it on time and sales and candlesticks. I always needed that third extra data print to give me something, just give me some sort of edge, right? And I also found that the options market offers retail traders a lot more data than other sides. So like comparatively to the stock market or the futures market or even the Forex market, where you don't really get any data at all. Of course, the banks own that market, so they get to see everything on supply and demand. But when it comes to the options market, now it's interconnected with the major stocks, SPY and QQQ. I found they just gave me the most relevant information for when the time came to make a decision whether to go long or short. So it's always helped me.
How did your consistency evolve over time, and what factors do you believe helped to improve your consistency?
Let's talk about the psychology aspect, because I know this is everyone's favorite topic, and it was definitely the psychology part that helped me throughout the whole process. And but buddy, and let's talk about this. There's no real psychology without facing the pain of not only your mistakes but your loss, right? You need to build that resilience. That's what always helped me. So every loss becomes a new learning opportunity rather than failure. That's how I always looked at it. So it just time and time again. It took time. It took years. There's no way I learned that craft within a few days. It took a long time. You need to go through that struggle. So so after I analyzed it, refined my strategy with timing, understanding marketing conditions, option flow, like the psychology aspect kind of came. It just naturally came with time. So like once I got over that mindset that losses are never to be feared, but accepted as a natural aspect of trading, that's when I was able to solve the most important step of psychology, really. Like once I was able to just accept the loss if it goes against me and prepare for the new day. So by embracing this mindset, definitely helped me reduce emotional spikes that also could cause FOMO and overtrading. So like I said with the example, once price, let's say, squeezing at a certain level rapidly, instead of holding on to that loss, I knew right away it's invalidated, and I cut my losses quickly. So that experience gave me helped me protect my capital over time. So the one rule I always remind myself is to stay away from the lower time frame as well, because that would always increase my stress levels. Either the 1 minute or the 5 minute on the candlesticks. Lower the time frame, higher the stress. Just stay away from that.
But you're day trading. I mean, so when you day trade these futures, what kind of time frame are you using?
So I don't like to look so much into the candlesticks. Like I said, I only look into the candlesticks when I'm live into a trade and I'm about to take profit or trailing it down. But once I'm making my decision or entering the trade, I like to stay zoomed out, because it's not so much on the candlesticks. It's so much of where we are, what time of day, and what the volume is giving me at that certain period of time, whether it's options market and the futures market. So it's more so just all those like what time, where, location, and the volume. Like what does it give me? Candlestick doesn't matter to me. Whether it's like a bullish forming candle, like 15-minute, or a bearish forming, or an engulfing, or a three bar pattern. I feel like for me, those are just distractions. I stay away from that. So that's definitely helped me.
Earlier, when you were talking about resistance or support, many investors imagine looking at a chart and saying, "Oh, look at this double top, triple top, or double bottom," and it looks like it's strong support here based on what I see the chart. But it sounds as if that when you're also looking at the options market and concentration of positions for gamma exposure on the call and the put side, that couldn't they have their own levels that are not necessarily indicated or obvious by looking at just a chart?
Oh, 100%. Like they have all the tools. They have all the advantages, right? So that's why I always tell myself, I only need to jump on that trend once a day. And as long as I'm on that trend once a day and try to pick up that one impulsive move, that's good enough for me. I don't need to pick up like the entire move of the day. I don't need to pick up all 5 impulses of the day, because I know I don't have all the information, like you said, like the institutions, the banks, the algorithm, which we can get into maybe later if we have time, is the one that dictates the momentum shifts of the day. I never like to stay greedy. That's why I always look to trail my profit, either take half off at a certain level and trail the rest if it continues the sell or continues the buy. So it's all about capital preservation, because you never know when the momentum's going to shift. It can happen at any time. I've seen it happen at any time. I've seen it happen during New York lunch. I've seen it happen even before power hour, and the power hour is dead. It's crazy. At all, like there's a shift. A shift can happen at any time, and the algorithm creates that shift. Yeah.
I see. So getting back to the psychology, then, when you see a big spike and you're long and you're on the correct side of the trade, how often do you have feelings of like, oh, this could be really it, and you know, you're on a strong trend and you're already thinking of all the money you're making? How do you keep the discipline to cut some of your position? Because the old saying, the trend is your friend. Well, why not just keep riding it? Who knows how high it could go?
Yeah, it's the experience, my friend. It's the experience where so many times I thought this could go further, and it comes right back to my break even and takes me out, or I just start increasing my stop loss. It's just that nightmare or that memory. That's why I said, like, you need that memory, you need that experience. You need to just trade, live test, forward test more and more, because if you don't have that pain in your mind of what happened so many other times, so many years ago, then you're never going to be able to create that discipline. So that's why I created that strategy where I cut off 50% once it hits, let's say, my next level. And then whether or not it continues, I just trail it. And if it takes out my trail, and maybe instead of a nice 4 or 5 to 1, it just gives me, let's say, 1.5, 2 to 1, I'm happy with it and I'm done for the day, because I accepted that the market doesn't want to continue further, doesn't want to push further or start squeezing to the next level. And I accept that factor, because for me, end of the day, trading, I like to look at it as passive income. I like to look at it as, because if I look at it as passive income and not some exotic way to make revenue, then I can keep it consistent every day. That's the whole purpose. Because that's another thing that I like to start increasing in my personal portfolio is passive income. Have other ways to create passive income, whether it's real estate, whether it's high yielding dividend stocks, and also trading, and keep it all the same. That definitely creates consistency with the corporation that I was able to build with my own firm. So
I see. So is it your habit then to periodically take out profits that you generate from day trading and put them into other asset classes? And if so, kind of what other asset classes do you put in, and what are your other styles of investing?
Of course, yes. So I usually like to withdraw weekly or biweekly, keep it consistent. And first I calculate my expenses, my mortgage, everything first. That's, comes first for the family. And then whatever I have left over, I redeploy into a new business venture, whether it could be like real estate, it could be land as well, but land is longer term, or dividend paying, high yielding stocks or funds that can just over time just pay me a nice 4 to 5% per quarter, per annual, and kind of let that ride until retirement. So have that capital preservation and make just extra income, low taxable income. That's steady and not stressful. So, like I don't need these exotic big moves. I just kind of keep my trading the same as I keep these other dividend payouts. And it takes time, right? Like I see so many portfolios online. Probably the only YouTubers and portfolio guys I would like to follow online are the big dividend guys. And they all say it took 10 to 20 years for them to build a sizable portfolio just to actually start generating good enough income per month where that's all they need to rely on. But it takes time, right? Like I'm in my own early 30s. I know I'm not going to be able to build a sizable amount until probably maybe another 10 years, but I'm slowly building that, mainly into like funds and other like individual stocks that pay at least on average 4 to 5%. Because I learned that lesson as well is if I try to find those stocks that pay higher dividend, like 10 to 15%, it's a little too risky. The risk is too great on that sense. I just like to keep it very conservative. Yeah.
Right. So when you were in the Chat with Traders community, you were known for using multiple funded accounts to build your portfolio.
Yes.
Was that difficult to manage, and how did that impact your trading in any way?
No, it wasn't difficult. I always looked at it as an investment. That's how I always looked at it. So, you pay the challenge fees. Let's say you pay $500 for an account. And if I was able to, over time, either in a month or two, 10 to 20x that amount, then that was a good return on investment. But I would, of course, during my challenges, be a little more aggressive. And then once I became funded with these prop firms, I would be a lot more conservative. Just risking like 0.25% to maybe 0.5% per day. Very easygoing. And then once I get my payouts, I get paid right away. and just use as an investment. I haven't been using these prop firms as much lately. I don't want to talk too much about it, but of course, with especially on the CFD side, there's been a lot of businesses going down. But like any investment, there's a risk. That's how I look at it, right? You can't expect these companies to go on forever. For me, I didn't take it personally. I had no emotions behind it. I used one or two of the companies as well that went down. What can you do, right? Like same as any investment, any stock you play out, there's always a risk for that company going down and your investment going to zero, right? There's always that risk. So for me, yeah, that's how I always looked at it. If I was at least able to 5 to 10x return on that investment, I found it to be a good decision, to be honest. And yeah, like currently right now, it's mainly trading my corporate portfolio. But of course, like I'm not telling anyone not to or what to do. As like an early trader or even as a seasoned professional trader, but it's definitely a good way to leverage your capital as well as network and build a community as well. So not only your own community, but like talk with like-minded professionals. I think it's very important.
Yeah. Well, speaking of which, one person that was very prominent in the Chat with Traders community and who was also interviewed earlier was Patrick Peterson. And I'm kind of curious to learn what did you learn from him and other traders that you observed in these various forums and communities.
Yeah, like that. Of course. And then like I learned a lot from Patrick. He's gone through it all. He has lots of experience, and I'm still learning from him. And I are still, we're still working together and enjoying our time. And yeah, it's always had positive feedback about him. And yeah, like the power of networking is so important. I feel like it's something that's not talked about enough in the trading world because it is a lonely journey. And I find it very important to go out there and network, whether it's a community or, like during a lot of these prop firm companies as well, provide that ability to network, or sometimes in person if you're in a major city, and like go out there and meet other traders as well. So it just, allows you to connect with like-minded professionals with the same passion as you have. And yeah, like these connections are invaluable because they provide opportunities and exercises that you wouldn't seem necessary unless you came across them on your own, right? Comparatively to the corporate ladder, of course, that's the one thing I do miss is, the company parties, right? Like the afternoon session, like the times we're able to come together with other coworkers, especially if we work downtown in the banking sector, a lot of good times, whether during lunchtime or after work. And yeah, it's just always, that is definitely like a connection that a lot of traders miss. But yeah, when CWT was able to provide that with the community, with a lot of the Zoom calls and the face-to-face, we found that experience very inspiring, to be honest. So when Patrick and I were able to meet yourself and Tessa and have all those events and create the opportunity for people, like we don't regret anything, and it was a good experience. So and especially when you're surrounded by all those people that are dedicated as well to the same craft as you are, it even makes it even more motivating to stay in the game as well and kind of elevate your thinking and your approach in trading. So and like once you're exposed to these new perspectives, different methodologies, right? Everyone's going to trade something different, which is fine, but also can help refine your own process. So whether it's learning from someone else's mistakes or successes, the diversity of that thought within a network is definitely a good tool for personal growth as an investor or a day trader. So.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So then, did you experience times like live during the day during the day? You're considering to go long or short something, and you throw out an idea, or someone throws an idea to you, like right there live. Have you found situations where you were able to improve, or you learn things on the fly when you're sharing these ideas, or is it mostly after the market is closed?
I would say, Ian, because of course I've experienced it all, whether it's pre-market, live, or post-market. I found the most important time was definitely pre-market and after-market, because everyone has their own strategy. Everyone creates their own buys. I feel like it just got a little too noisy live when you're trading. I think everyone should just concentrate on their own, focus on their plan, and maybe come together before the market, going through some checklists, going through some ideas, or just talking it out. And then boom, you shut down, you trade, you manage. Because at the end of the day, you're not managing anyone else's account. It's your account, it's your money. And then come together afterwards. Have some accountability. Talk about, the post-market, what happened, how you looked at it. And if someone had it like, a different way of looking at it, looked very interesting, make a note. By the end of the day, I think live, I felt, like my biggest learning curve. And of course, right now it's a little different because I'm helping. I have a couple students. I'm consulting with Patrick as well. So now, we found together with Patrick, it's best to create that roadmap pre-market, let everyone manage on their own because it is their own capital, and then come afterwards with some accountability and speak about it. Because you look at all of these professional desks, all these institutions, Citibank, JP Morgan, Goldman, they all come together afterwards and talk about their trading day, talk about their ideas, their strategies, because it's important. You can never be left in the dark, especially afterwards. That's important. Whether it's a winning day or it's a losing day or it's a break even, you always need to speak about it. So find a partner, find a group, find a community, even a family member. And I think it's highly important to speak out loud about it. Because you look at any other profession, you're never in the dark, you're never quiet. Even if it's a 2-man team, you're always providing with meetings, month end, quarter end. You always have a supervisor speaking about, your work, your workload, whether it's good performance, bad performance. So you could call it either a performance meeting or some sort of accountability. I think it's highly important to have that in your trading career.
Yeah, great. Well, certainly we hope to reopen the Chat with Traders community live trading room again in the not too distant future. So what would you say are areas that you struggle with most as trading?
Yeah. That's a good question, Ian, because we all struggle in certain areas, right? Whether it's, with your strategy or could be even after the trading day is done. And for me, definitely, I would say the biggest challenge as a risk manager would be trying to escape the market. That's trying to escape the market. That's always been my
escape the market. What? Yeah,
always been my biggest struggle for sure. So because we always have our mobiles, so the news, the chat rooms, they're always available 24/7. The chart's always available 27. So always trying to remain unplugged or not plugged into the market. That was always my biggest issue. Trying to unplug and be focused on what's in front of me. That's always been, because the wife always commented, of course, I'm on my phone too much, looking at the markets, even though I'm done for the day. Because I try and look at it as work, right? Because once even when you're finished your 9 to 5, you're not thinking about your work, you're done. So that's how I should be thinking about the markets. But the thing is, because I'm so in love with the markets, and truly, I enjoy this profession so much. It can of course, at times seem a little too addicting. But that's definitely my biggest struggle: to pull away, to check prices, see maybe what the oil market is doing, or you always, because even though I don't trade the oil market and gold market, it's always interesting to see what those markets are doing, right? Once that New York volume goes away. So just always read the latest headlines. And just having that convenience of the mobile phone. Because, of course, back in the day, we didn't have this, right? Everything was either done on the computer or the newspaper. But because everything's accessible 24/7, it definitely is a big struggle of mine to come down sometimes to reality and try and get that balance. I'm not saying it happens all the time, but sometimes I catch myself being pulled right back into the markets, even though I'm not trading. So just being aware of more so what's in front of me, and being, more in tune with the family. Of course, I'm not saying I enjoy the freedom. I'm not working as much as I did before my 9 to 5, but because it's, a high stress profession, and just being always feeling the need to stay into it at all times can be, mentally exhausting, and also possibly create some poor decision making as well. So, what I've learned definitely in that area is just to create strict boundaries. I've definitely been better at that now than I have before, especially last year. So just establish rules of when I can access the market and switch it off entirely. So I just try to limit myself on the news sources that I look into, and try and avoid any sort of excess information that could lead into overload. So that's definitely
Yeah, well,
big struggle of mine that I'm working on, Ian. So
yeah, well, I can certainly see the passion expressed through your face and hear it in your voice, and it's great that you found an industry, a hobby, a passion that you're really excited about and love to learn. So, thank you very much for coming on Chat with Traders. How can our listeners get in touch with you?
Yeah, of course. Yeah. So all my business information is on Twitter or X. It's at Libra_trading. So I was born as a Libra, so that was the handle I of course stuck with. But yeah, you'll see me on there as Steve B, and all my information and the company I work with the options flow data and everything. So yeah, like if anyone wants to reach out and follow me, all my information's there. So yeah, thanks again, Ian and Tessa. I'm glad to be here and maybe one day do this again. So yeah, thanks again. Appreciate it.
Yeah, fantastic.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Risk is always a function of probability and magnitude of an event. Even if you say, look, the probability that such correlation will break is very low, you always have to remember when you size something, yes, but what is the magnitude of a loss in case that probability happens? And when you try to look at statistical inconsistencies or arbitrages, they seem like a certain thing, right? So the problem of a certain thing is that when it goes the other way, it can cause large losses. And that's what you should consider when sizing a position. So rule number 1, I think, for an investor is stay in the game.
Markets, speculation, and risk. This is the Chat with Traders podcast.
That's right. It's Chat with Traders, episode 289. We're so glad you're with us and hope you're doing well. I'm Tessa, your co-host, and I'm having a blast co-hosting alongside Ian and bringing to your ears fresh conversations with guests from all walks of life. Our goal? It's simply to continually spark those aha moments and ignite your curiosity, and we hope that you are enjoying the episodes so far. Today, Ian speaks with a very special guest. His name is Alfonso Pecatiello. He goes by Alf, and I'm sure some of you, if not many of you, have heard of Macro Alf. who is quite well known in the investing and financial community on X, we get to tap into Alf's mind and experience as a big-time discretionary macro investor. Alf's approach to the financial markets is deeply rooted in macroeconomic insights, identifying market imbalances, and disciplined risk management. Having managed a $20 billion fixed income portfolio, Alf has seen firsthand how understanding market dynamics and timing can unlock significant value. Alf's strategies focus on spotting crowded trades, leveraging market dislocations, and carefully sizing positions to maximize returns while minimizing risk. And there's so much more to this fascinating conversation. With the launch of his hedge fund, Polyneural Capital, he is bringing this disciplined, macro-driven strategy to a broader stage. And there's so much to unpack here in this hour. So let's dive in already. Ladies and gentlemen, we are so pleased to present Alf Peccatiello, originally from Italy.
Well, Alf, I'd like to welcome you to Chat with Traders.
Thank you. It's my pleasure. I listen to basically almost every episode. So, as I said, it's such a pleasure to sit on the other side of the chair.
So where are you now?
I am in Amsterdam. I live and run my hedge fund from the Netherlands. I am very often in Italy, but let's say officially I am in Amsterdam. And right now I am actually.
Okay, fantastic. Well, let's dive into your background. Tell us a little bit about, you said you grew up in Italy?
My background is that I was born in a village close to the Amalfi Coast, which sounds very fancy, but actually the Amalfi Coast is, but my village not really. It's one of these very poor places in the south of Italy, but it's also full of authentic people, and you get taught a bit of grinding mentality, I guess, right? So you have to work hard to achieve what you want, and nothing is for granted. Everything you got to earn. And, you know, you also come up with this Italian accent like the one I have, which I think is a perk, or negative or positive, I wouldn't say, but it's it's a nice place to grow up in. It teaches you the hardworking mentality, really, and you have to try and achieve whatever you can and fight hard. And then I moved to the north of Italy for a bit to study at university, and then I actually won a scholarship to go to Germany. This was eye-opening when I went there, because you see a very different approach to life in Northern Europe than it is in Southern Europe, right? It's a different set of values. It's much more productivity oriented, and also much more, I would say, individualistic as a culture than it is the south of Italy, where it's an agriculture driven place. It used to be a lot more, but still today it is. So people tend to help each other like in a village. And in North of Europe, it's a bit different. It's much more a business oriented culture. So I got a little bit some hard time when it comes to cultural clashes, but ultimately I'm still here right now in Amsterdam, in the Netherlands. I moved here probably 8 or 10 years ago to start working for ING, which is a Dutch bank. So I worked for them for 8 years between 2014 and 2021. It was a very good career and period, and I learned a lot, and I'm grateful. Ended up with me running a very large fixed income portfolio for the bank, about $20 billion. So anything that had to do with bonds and derivatives and anything fixed income, I did. I made mistakes. I learned, tried to adjust to it. And then life went on, and launched my research business, the Macro Compass, which is up and running. And now, pretty much today, launching my macro hedge fund, which is called Polyneural Capital. And Polyneural had to be an Italian name, right, at the end of the day.
What did you study at school? You mentioned that you went to both an Italian university and a German one?
So I was in Siena, this place in Tuscany, which a few listeners might be aware of because everybody likes to go to Tuscany for some reason. So I was in Siena. I studied quantitative finance, a very math-oriented program, I have to say. Also very useful to understand stuff like option pricing, derivatives pricing, for example. And then I won a scholarship to go and study in Germany at the European Business School, which was, again, quant finance, but a little bit more, I should say, less mathy and more computational, more applicable. But at the end of the day, I really wasn't a quant. I can understand, let's say, the dynamics and what is necessary to make a model work, or what are the let's say, the statistical properties of something, of variables, for example, but I'm not a quant. So at the end of the day, this was quite an experience in trying to, learn a side of finance that I think a lot of people focus on because it's scientific. And so that's something people find comfort in. But markets and also macro, which is my specialty, are a lot more about connecting the dots and understanding how different things impact each other and risk management. And it's a lot more about that than it is about being a scientist, really, or only a scientist.
So while you were at the university, or perhaps even before, did you open up a trading account? Did you make any investments?
Yeah, and lost a bunch of money too, of course. So yeah, of course I tried to do that, and with no idea of how to size a position or how to watch for correlations in your portfolio or anything along the line of that. Just basically punting based on my gut, which is a great learning curve, if you ask me. You soon realize, unless you are completely not self-aware, but you soon realize that you're not equipped for it, right? And therefore you need a process. And this was also the first thing that I got taught by my mentor at the bank, who's a guy with gray hair. And I suggest everyone to look for mentors with gray hair, or no hair also works, as long as they've been in the business for a long time. This person was a prop trader in the 90s, when banks were, still allowed, before Volcker rule and so on, to actually do prop trading or engage in prop trading. This means that he had an extreme focus towards how do you size a position? What is your plan? Not only what is your plan to stop the trade, but what is your plan to run your profits? How are you going to be able to generate this positive tail in your distribution of returns? How are you going to be able to stay in a winning trade? And also, if the trade has negative carry, so if it's something like you're buying the Japanese yen, for instance, which is very often a currency that offers no interest rate pretty much, and you're borrowing a currency that instead you have to pay interest rate to borrow, like you're borrowing dollars and you're paying 4 or 5%, you're buying the yen. Well, I'm sorry to break it to you, but you're going to lose money over time just by the fact that interest rate differentials work against you. So that's something that we will call in macro negative carry. Okay, what is your plan there? For how long are you going to allow this negative carry to bite you until you basically stop the trade out? Not because of price action, but because of time, because of bleeding this negative carry. So it was all about process and framework, and very little about being right, having a crystal ball. And this was quite a lesson.
This guy who was giving you this advice, was he in your first job? The first job that you attended? And tell us about your first job, and how did you get it?
So the first job was in the treasury of ING. So I started as an analyst, basically, in the treasury department. And my job was to, let's say, disentangle macroeconomic conditions and how they would affect the various bond investments of the bank, various fixed income investments. So it's top-down macro, but it's also bottom-up on each issuers. Like if you buy a bunch of European bonds issued by different European countries. So, do you prefer France, or do you prefer investing in Austria or in another European country? So it's a lot of bottom-up and top-down macro analysis. And this was my start, right? And then after a while, they said, okay, this macro analysis is good, but we need your hands as well when it comes to risk-taking. And this was the start, right, of effectively the evolution from a macroeconomic analyst to an investor, to a macro investor that invests in a fixed income portfolio, being able to do a lot of stuff in fixed income, from choosing different levels of credit risk. So are you going to invest in the safest countries or the most risky ones? Like, I don't know, you're going to buy some Greek bonds, for example, which when I started were something you wouldn't want to touch, or at least your risk manager got very upset if you mentioned that. Or are you going to buy the short end of the interest rate curve, of the yield curve? Or are you going to prefer investing in the long end of the yield curve? And what is your macro reason for that?
So were you given the freedom to choose the investments? I mean, because you're posing these as questions, how much flexibility did you have in making recommendations?
Yeah, quite a lot, actually. Of course, there is a framework. So when you join such an institution, obviously what happens is that you cannot operate freely. You have to operate within what's called the risk matrix. So the risk matrix comes to you in the shape or form of, these are the issuers you can buy. This is the credit rating you're allowed to go as low at. For example, can you buy below investment grade, or can you only buy investment grade? And what duration can you have in your portfolio? What is the average duration? Is it going to be 7 years or 10 years? What is your maximum duration? There's a various amount of limits, basically. So you should think of it like a matrix, multidimensional matrix, and you have to move within this matrix, trying to optimize for risk-adjusted returns.
So when you have this flexibility, were you able to see what they did prior to you joining the bank, like to get an idea of how they did things before and how you did things or wanted to do things differently?
This is interesting. The answer is no. And the answer is no because of regulation. So a lot of European and US banks, basically almost all of them, are forced by regulation nowadays, and after 2013 only, that's a rule, to have large fixed income portfolios. These are called high quality liquid assets portfolio, HQLA. And what it stands for basically is regulators that during the crisis of 2008, 2009 figured out that banks did not have enough liquid assets to face a crisis situation. So what if everybody wants to withdraw their deposits? Are banks able to serve such an outflow? And they figured out they weren't because they didn't have enough liquid assets, bonds mostly, to liquidate. So guess what? Regulators figured out ex post, they hardly do this ex ante, but ex post figured out they needed to correct the problem. And they went to banks and said, how big is your balance sheet? Can you stress it out for how much deposit outflows are you going to have at any point in time? Okay, now buy me an equal amount of liquid assets that you can liquidate on your asset side and service eventually deposit outflows. And so bonds were a big part of it. And effectively, the bank had to create a new investment framework, like many other European and US banks, to handle this HQLA portfolio from 2013 onwards. I joined late 2014, so there was not much history there. Which was interesting because you could design together with your risk management and your front office team, you could design an investment framework together and draw on the experience of gray-haired mentors like my mentor who did this in the past, maybe in a slightly different format, but they had taken risk in the first instance in the past, so they could be very helpful there.
And so you mentioned bonds a lot. Were there any other type of assets that you looked at advising to buy at this? And if so, what were they?
So the mandate evolved over time, right? I mean, you start with what the regulator suggests you being the most preferred asset class to do that, and that's anything in fixed income, really. So bonds are very flexible because they can express plenty of views, from, as I said, different level of credit risk you can take in a bond, to different parts of the curve you can play with. This is much more to do with macroeconomic cycle and your view on inflation or the response of the central bank. And then there are much more technical things you can do in bonds. So you can do futures or you can do bonds. So the famous bond basis trade, where you basically try to look for discrepancy between how bonds are priced and how futures with the same bonds underlying are actually priced. So there are a lot more strategies that you can figure out only using fixed income. And we actually were very focused on that for the first 3 or 4 years. But then as time went on, there is an interesting thing in markets that works also for large institutions in general, banks, pension funds, insurances. When volatility becomes compressed and it stays compressed for a long period of time, people get dragged on the risky side of the curve, on the risky side of the spectrum of the investment mandate. It's almost like a gravitas. So when the European Central Bank cut interest rates to zero and then started quantitative easing, so we're talking like 2015, 2016, okay? Not everyone jumped immediately the gun and said, all right, now we got to go and buy all the risky assets we can because, look, we have to. Not really, it doesn't really work that way immediately, but instead make it so that it's a couple of years that you have had zero rates and QE ongoing and no volatility spikes, nothing at all. Even the most conservative risk manager will be pressed by his front office people to say, hello, now we really need to do something. So it's a little bit of a herd behavior, really, which you see also in markets and you see it in institutions. And so you tend to broaden your mandate and you say, yeah, well, now we need to do something else, right? We need to go and do different asset classes and be more aggressive with our investment mandate.
Now, when you're talking about when the volatility gets low, are you talking as reference to the VIX index or some other indicator?
So there are a couple of indicators for vol that you can use in market or volatility. So there are two famous ones, which are, I think, decent proxy to look at. So there is the VIX, which basically looks at the market expectation for the S&P 500 implied volatility or realized volatility to be for the next 30 days. Okay, so that's what you're looking at. You're looking at the market interpretation of how volatile the S&P is going to be. And then there is a very similar thing, which is called the MOVE index, like move like in moving. And the MOVE index does, I'm going to approximate now, pretty much a similar job for bonds. So it tells you what investors are expecting the volatility to be in bond markets. And if you look at both these indices, holy moly, they were really, really low throughout the period going between 2015 and 2019. There were some occasional spikes, but for most of the time, these levels were really, really low, to the point that, as I said, with the passage of time, even the most conservative risk manager said, yeah, you guys are right. We need to make money somewhere, take more risks.
In your view, how long do these cycles typically play out? And are there any red flags that pop up on when this low volatility period will looking to be, end soon?
Yeah, I think this is a $1 million question, but there are things you can look at. So what I learned running money at the bank is that you don't need to be right to make money. This is going to sound very strange, but you don't need to be right to make money. Or let me correct the sentence or adjust it a little bit. It's not a sufficient condition to be right to make money. What is necessary as well is that you surprise consensus pricing. So when consensus is particularly strongly opinionated about something, it takes a small change of an event or something that changes that opinion a tiny bit to cause quite a large swing in prices. This is because the marginal buyer will be able to move the price quite aggressively as there is a herd of people which are mispositioned, basically, against a new set of information. So as a macro investor, your job, more than being right, which I think is pretty much of an ego game, and I think social media is even, turbocharge this game. If you go on Twitter, everybody needs to be right all the time in calling what the next macro event will be. As a macro investor, instead, your job is to identify when something is getting too crowded, when consensus has an opinion which is too strong. And there are multiple ways of doing that. But in my opinion, when it comes to low volatility, for example, right? So when is that this low volatility has become so entrenched that people are extremely relaxed about it? Well, you can take a few cues by tracking how carry trades are doing. So remember what we discussed at the beginning of the podcast, right? We said you sell the Japanese yen, you buy a high-yielding asset. Wow, fantastic. You're getting paid while nothing happens. Low volatility means, by definition, nothing happens. You're just clipping interest rate differentials by borrowing the yen, 0% interest rate, and buying the Brazilian real, 10% interest rate. Beautiful. Now, when such versions of carry trades have worked really well, so that it seems like a trivial thing, an unrisky thing to do, that's generally a good signal for you to be more careful, for the fact that too many people might be sitting in these carry trades, in these short volatility trades, and therefore it takes a tiny bit, like it's a butterfly effect. It takes a small contrasting source of information or price action to cause a very large drawdown and a very large bout of volatility.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
What indications did you see, say in late July or even earlier, regarding the Japanese carry trade that blew up in early August? Were there any clear signs for you? Because this carry trade's been going on for a very long time, and I'm sure the bears could make this argument, many, many times, right?
Yeah. So in the hedge fund, we deploy a model that basically looks at the crowdedness of such carry trades. And how we do this is from a top level, we create a basket of these short volatility trades and we track how they're doing. And what we track specifically is something called the Sharpe ratio. So what we do is we basically understand how investors have been generating risk-adjusted returns. So that the Sharpe ratio is basically a measure of how much return have you made against how much volatility have you taken. So if the Sharpe ratio of a diversified basket of carry trades has exceeded 1 to 1.5, so people have generated very competitive risk-adjusted returns by merely sitting on carry trades, this has probably attracted a crowd of people towards going there because, look, it's just printing money. It's a small butterfly effect to cause a big reverberation in It's a small butterfly effect to cause a big reverberation in markets.
I see. So what you saw in June then, did that get your attention as because it was rare? It didn't happen too often in the years leading up to the blow up last August. Was the Sharpe ratio considerably lower?
Yes. I mean, if there are very few occasions over the last 30 years where you can generate Sharpe ratios by selling vol, so being long carry or other versions of you being short volatility, where you can generate Sharpe ratios above 1. Every time you were able to generate Sharpe ratios above 1, even 1.5, they were always followed by a drawdown, which again tends to be an indication that you can only squeeze and you can only crowd a trade as much before actually it starts to be very complicated to keep generating return because you can't really attract any marginal buyer anymore, while instead it's very easy to attract a marginal seller. You just need to spook him a little bit and then outsized negative reactions can happen.
What got the Japanese carry trade to unwind there in August? I mean, was there
trade? It's irrelevant. I mean, when did you do that? You should find your own way and test it and back test it. But the main concept I want to come across with is being right. It's not a sufficient condition to make money. And I'm going to say now something else. Victor Agani, who was one of the co-founding partners of LTCM, the huge hedge fund that then unfortunately blew up in the late 90s, he now writes a lot about how difficult it is to make alpha and to how important it is to size positions correctly and how important is risk management. And he makes you play interactive games. So this is something I would recommend the Chat with Traders community to do because it's a very strong didactic experience. So if you go on the website, I think it's called, let me check, Elm, E-L-M, Elm. So if you go on Elm website, Elm Wealth, I think is the proper name. So if you go there, you can play a couple of games, right? And so there is the last one he published, I think, yesterday. It's amazing. It's called the Crystal Ball Challenge. So again, this echoes my idea that even if you have a crystal ball, even if you are right, it's really hard to make money. So the game is structured in a beautiful way. What they did is they took a bunch of episodes of the last 30 years where there was a big market event, either in the stock market or in the bond market. So I don't know, some big Fed decision or labor market data or inflation data or some big stock market information. And you get to see that info one day before. So this is the dream of every trader, right? You have the market moving info one day before. Okay, cool. Now what? So he then says you can do the S&P future or the 30-year bond future. So you can trade stocks and bonds. You can go long, you can go short. And you can choose how much leverage as well you want to put on each trade. So by reading the news, you will be utterly convinced this is bullish for bonds or bearish for stocks or whatever, so you can lever up or more. Remember, you have insider information one day before. How easy is this, right? And then you can hold the position for one day. So basically, you are getting an early peek into the info, and then you go long or short. And at the end of the next trading day, you are automatically unwound from your trade. Please go and play that game and figure out how hard it actually is, even knowing information, to make money. And his main point is, look, how much was it priced in? This information you don't know, right? Because you don't have a context. It's taking info from the 1987 and 1995 and 2014. And so you really don't have the context of what was going on. Did the market already know this? And when the Federal Reserve cut 50 basis points a few days ago, the first reaction of the bond market was to sell off. What? The Federal Reserve has actually cut 50 basis points. And at some point, you had even the stock market didn't really know what to do at first, right? And instead, you would expect, what do you mean? The Fed cuts 50. So it's 50, the stock market must rally. But what if they were cutting 50 basis points because a recession was coming? Would it be the same for the stock market? How was the market positioned ahead of the meeting? And so go and play that game, because I think it's very instructive as well for understanding how hard it is and how important it is to understand how crowded positions are and how consensus is pricing something.
So then what are the tools that you look for or indicators to show that the consensus is priced in fully or partially? Do you use indicators or websites like the Commitment of Traders report to get an idea on how crowded a trade is?
I think the COT is good for certain things and is not good for others. And the reason why I say this is that the COT does not know about hedges. So I was a very, very large bond investor. And if you would have looked at the COT derivation, maybe of my position, you would have gotten a completely misleading set of information, because the COT doesn't know whether I'm hedging something. So for example, let me make a quick example, right? So when you look at bond future positions, right? And then the COT is going to tell you, I know, like people are super bearish on treasuries or super bullish on treasuries, whatever. What they're looking at is future data. So they're looking at listed futures, and then they can see the open interest, and they're trying to derive something out of that. But let me break news now to people. Probably people already know that. But what if I took a large long position in the 10-year future, then I'm shorting the bond future against it? So for me, that is not an open position in the bond itself, but it's a relative value position. So I'm going long there, but I'm going short somewhere else, which means that if treasury prices go up and down, I don't really care that much. What I care about is, are treasury prices going up and down against German government bond prices? Because this is the relative value trade that I made. And they don't know about that. Even worse, they don't know about hedging in swaps or derivatives or options that I might be using to hedge my position. And so it tends to be a bit of a partial information, I would say, specifically in markets that are very complicated, like the bond market.
So how long does it take you to look at all these different markets and synthesize all of this to get a viewpoint on how crowded a trade is? Or is that even possible?
This is the key question, because process is everything, especially if you're a macro trader like me. The macro is beautiful because it's unconstrained, it's diversified, it's so many markets, and that's a problem. It's a problem because you're supposed to be able to screen and track new information, whether trades are crowded in which markets. And the only way you can do this is if you build processes, frameworks, and systems. That's the only way you will do this, unless you have an army of 100 people doing that for you, as in like manually checking stuff. And even then, I wouldn't recommend it because it's prone to mistakes. Instead, it's all about building framework, processes, and systems. So at my hedge fund, we have a ton of models and systems that are continuously screening for example, asymmetries or incongruences, I should say. So for instance, let's talk about correlation. So now we're now recording this at the end of September, and the news is that China is stimulating, or China is announcing a stimulus package. Okay, fine. So what happens is that Chinese stocks are rallying, but also correlated assets are interesting because not everyone can trade Chinese stocks. So people would be looking at other things, right? Or maybe they want to trade copper or the Australian dollar or anything that is historically very correlated with China. Okay. So when you have such big events, what we screen a lot for is, are markets that are historically correlated with these assets behaving as they should, or are they not? And if they're not, often there is an arbitrage. Arbitrage is a big word, sorry. There is a relative value opportunity you can try to exploit where you want basically to move towards the historical correlation or beta reaction, right? But how can you do this? How can you screen all these markets unless you have systems in place? You can't. And the same goes with tracking crowded trades. The same goes with understanding how consensus is priced. You can't do this manually. And so the answer to your question is, it doesn't take me a lot of time simply because there are systems in place. They take a lot of time to build, yes, but once they're there, then they do the job for you continuously.
The correlations are quite variable, obviously, depending on the time frames that you're looking at. What time frames do you look at when determining correlations, and when do you adjust them?
Yeah, it's a good question. So it really depends from what trader you are. At my hedge fund, we do macro with a time horizon of 3 to 6 months on average for our trade. So we don't need to be right or to have a time horizon which is a week or a day. We don't really care about that. We try to focus more on medium-term macro themes, which we also think are a little bit less crowded in the hedge fund space. Nowadays, with the birth of the pod models in various multi-managers like Millennium or Citadel, a lot of focus is on generating returns every week, every month. And that doesn't really optimize, in our opinion, for long-term macro trends that might take 3 or 6 months to unravel, which also means that our correlation, what we try to look at is stuff that is what we call macro correlated. So over a very long period of time, it has exhibited a stable correlation across regimes. And also, when you look at these assets, you can explain why they are supposed to be correlated. So Chinese stocks and iron ore or copper, why are they supposed to be correlated? Can you explain why? And maybe yes, you can explain it why, because China is a big source of demand for iron ore. So when they're stimulating, they're not only popping up their local stock market, but probably they're also projecting further demand or forward demand for these commodities. So as long as you can explain those and the relationship is robust over a long period of time, that's what we care about. What we're screening is for breakages, really, for abnormal behavior in pairs that instead should be correlated. And this is one of the many strategies that we run.
And so how would the correlation changes over time cause your fund to increase or decrease or even eliminate a position? I mean, how much would it have to move by?
Yeah, so the correlation in this case is an input for the model to start screening how pairs are behaving. So if pairs are strongly correlated, we would expect that when we have a breakout in something, then the correlated assets would also behave in a certain way. When the system spots an abnormal behavior, so basically the pair supposed to be correlated isn't really behaving as such, it flags a potential signal for a trade idea. So really the calibration of correlation is more of a, let's say, a check that the model has to do to tell us, okay, keep tracking these because those are really correlated. At some point, if the correlation goes down over time, so basically those two pairs used to be very correlated, and for some reason they're not anymore, and it is happening in some cases, so we can discuss about this, then the model would simply drop that as a potential pair to check, right? It will simply say, look, this used to be a strong correlation. Now it's not. So don't be surprised if asset A misbehaves against asset B, because over time, the macro correlation is just basically diminishing. And this is something you got to keep track of. And the question really becomes, what is your time frame? Like, new information is coming in. How valuable that new information about correlation is against your 10 or 20-year history. And there, it's a very interesting discussion, because one might just be variance. It might just be noise, right? It might just be that temporarily those two things are uncorrelated, and then they will convert back to their standard correlation over time. Or it might be that they're becoming uncorrelated for good reasons. So as a macro investor, it's important not only to look at models, but to always ask yourself, can I rationally explain why those two assets should be correlated, or why they should now become uncorrelated all of a sudden?
I see. So you're also looking at the various news releases and placing kind of a value judgment on what kind of impact those news releases have for the correlations that you're looking at?
Yes. It's unfortunately, I would like to systematize everything, but you can't. Well, now with large language models, you can try and train something and make it read news for you, but I would not recommend that if you're a macro investor. So there is always there's a branch of macro hedge funds which are called systematic macro. I'm a discretionary macro hedge fund, but systematic macro hedge funds are basically only trying to find statistical inconsistencies in macro asset classes and not really relying on their discretionary judgment of anything. Like you were saying, reading news is a human activity. It's going to be somehow discretionary and nuanced in the way we interpret what that news means. And frankly, I think that there is value in that part too. So we do that. We do screen news. We do spend time reading the news and trying to understand, importantly, has consensus already incorporated this new information? Or also, as one of the other mentors I have always tells me, listen to the game masters. The game masters are central bankers and policymakers, politicians and central bankers. So why are they the game masters? Well, because they have a huge impact as single agents. They have a huge impact with the decision making in what they can do for the economy and for markets. So now that China has come up with a facility that says you can pledge collateral in this facility, so let's say cash or bonds or whatever asset you have, and we will lend against it money that you can go and use to buy Chinese stocks. So now that you know such a facility exists, okay, it's really hard for you to say, oh, I think Chinese stocks are going to draw down 40% from here. Well, guess what? Because the policymakers are signaling to you, the game masters are telling you, hello, we can set up such facilities like the Federal Reserve did with the BTFP, the Bank Term Funding Program, where they basically said, give me your treasuries. I don't care what the price is. Is it 60 cents on the dollar, 70 cents on the dollar? I don't care. To me, the price, to me, Federal Reserve, the price is 100 cents on the dollar. That's it. They unilaterally have the power to decide that. They are the game masters. So listen to the game masters and importantly, try to get in the head of the game masters. What is their incentive scheme? What do they want to achieve? And if you're able to get a bit of an edge on that, then that discretionary judgment, the human discretionary judgment, can be very valuable as a macro investor.
How often do you hear of a fund blowing up due to a heavy bet on long-established correlations that suddenly change?
Unfortunately, very often. I mean, this has to do as well with risk management and drawdown control. So, look, stuff happens. You have value at risk, the most used risk model in the world, I would say, in the hedge fund space. It's value at risk, also known as VAR. So what VAR does is it just looks at history. It basically looks at history and it says, show me your portfolio. I will tell you, based on history, with a set probability, say 95% or 99% probability, I can tell you you're not going to lose more than X. Looking at history, which means also looking at historical correlations, right? Looking at what history has been for correlations. Okay, this is the most used risk model in finance. Okay, obviously you can see the flaw. Future doesn't always resemble exactly the past. So it can always happen that your model didn't incorporate a break in correlations, for example. So that can happen and you will experience it from time to time. If that causes your fund to blow up, then your problem is another one. Then your problem is your risk management framework, your sizing. Because probably the thing that you did there is you assigned too much risk to a single position in your portfolio. Risk is always a function of probability and magnitude of an event. So even if you say, look, the probability that such correlation will break is very low, you always have to remember when you size something, yes, but what is the magnitude of a loss in case that probability happens? And when you try to look at statistical inconsistencies or arbitrages, they seem like a certain thing, right? So the problem of a certain thing is that when it goes the other way, it can cause large losses. And that's what you should consider when sizing a position. The risk is magnitude times probability. So rule number one, I think, for an investor is stay in the game. Stay in the game is rule number one. Have a process in place to make sure that one single position can't ruin you effectively. That should be the rule number one.
Why is it that correlations of assets can go to one in a crisis or even in a sharp market sell-off? Is there such a thing as a safe haven asset to protect us against these dramatic drop-offs?
Okay, this is such an important part of risk management as well. So financial markets have become extremely leveraged. And the reason is that we have gamified, I would say, financial markets. We have given access to implicit and explicit leverage to pretty much everyone around the world. So now when you think of leverage, you normally think of borrowing stuff, right? And that's what people think about leverage, but it's not only necessarily that. Leverage in this case means being able to take an outsized amount of risk in markets, okay? And so options are one way to obtain leverage. Options are a product that has embedded leverage into them, basically, because by taking a small amount of upfront risk, you can take a large impact in markets, right? You can generate a lot of impact in markets. Think about GameStop, right? Think about people buying out of the money calls in GameStop and forcing the dealers at banks to actually go and chase and have to buy stocks to cover their shorts, right? So this is a great example of that. What this has led to as well is a situation where you now have a lot of investors around the world, including institutions, using leverage to either amplify returns or to, in principle, try to diversify. So what is the problem there? If you think of the famous risk parity approach by Ray Dalio, what that approach says is you should look at all the asset classes in the world, take exposure to all of them, be as diversified as you can. Internationally diversified stocks, bonds, commodities, the dollar, gold, you name it. Buy everything you can buy and buy it in a measure so that they have the same amount of volatility contribution in your portfolio. Now, each asset is more or less volatile than the other, so you have to use leverage to balance out this volatility, right? So if you buy something like gold is less volatile than stocks. So if you want gold to have the same volatility contribution to your portfolio, you need to use leverage and go and buy gold with leverage to make it have the same weight in your portfolio. So all these techniques use leverage either to amplify returns or to amplify diversification. But what is the problem really? When something bad happens, so let's say you are approaching a recession or you have a spike in inflation or you have something that shakes the system from the foundations, what happens is that people who have used leverage and who are now experiencing losses in one asset class, for example, their losses are also amplified. And so what's going to happen is that they will have to try and get cash somewhere to cover their margin calls, to cover their losses on leveraged positions. So what happens is really weird. It's like March 2020, when gold goes down and bonds go down, despite the Federal Reserve cutting interest rates during a pandemic. What? Well, what is very simple. It's because if I am getting margin called on my oil contract, equity contract, whatever I'm owning, I don't care what do I need to sell to raise cash and stay alive. I don't care what that is. I'm going to have to sell it. I'm going to have to sell my good collateral, treasury, gold, whatever it is, to raise cash and cover my losses. And so what happens is that all assets, as you said, tend to move together. Correlations go to one. And this is nothing else than the side effect of having very leveraged financial markets, both at an institutional level and now also gamifying the market so that even retail people can access explicit or implicit leverage through options, for example.
Do you know of any particular indicators that can clearly show if a market is leveraged enough to generate a asset correlation of 1 when the markets go down? Or is this just, does it take just very little leverage to do this, and we just have to accept the fact that this will keep repeating over and over and over again?
I'm afraid that I have to agree with your last sentence. The way we have structured markets is we have encouraged investors, institutional and retail, to take more and more implicit and explicit leverage at every occasion. And again, it's a policymaker decision, because every time that you have a situation when correlations go to 1 and the market looks very scary, guess what? We introduce another facility to limit volatility. That's what we have been doing for the last 20 years. That's what we have been doing, and that's what we keep doing all the time. And so this sends a very clear behavioral signal, I would say, to investors, that ultimately you don't want to be the guy that, if the analogy here is a very crowded party in general. So everybody's dancing and the party is great. And the sooner you join the party, the more fun you had. So if you joined the party in 2012 and you understood policymakers are going to have as objective to lower volatility in markets as much as possible, where you were an early joiner to the party, and by now you have had stellar returns investing in any asset class, any asset class worked, gold, stocks, bonds, anything, real estate. So now what is your objective? Your objective is to enjoy the party, but not to be the guy at the front door when it gets very crowded towards the exit, when more people understand that the music is about to stop. So it's like a game of musical chairs, pretty much, right? You always want to try and dance, but you want to be able to sit. You don't want to be the guy heading to the door together with anyone else. Is there a way to track this? That's very, very hard. But so the answer is no, I'm afraid. But it's important in your risk models to take this into account. So when I see people having their parameters for risk on something like a correlation matrix for the last 20 years, what they're doing is they're just taking the average outcome every day or every month for the last 20 years, and that's their base. Well, guess what? If you know that the system is created in such an unbalanced way where very often you are going to have correlation going to 1, do stress your portfolio for what happens in that event, because it might repeat every now and then. And actually, by the way, we're structuring markets, I'm afraid you're right. It's going to repeat more often than not going forward.
For individual investors that are listening to this, some may say, this all sounds fine, but it sounds very complex to me. How can I take advantage of this strategy? I mean, I've invested in some mutual funds and I hold a bunch of different stocks in the tech sector and what have you. And I feel like I'm pretty well diversified. Isn't that enough? I mean, what can the individual investor do that's not too overly complex?
Oh, that is a very good question. I would say the following. First of all, rule number 1 should be try to get exposure to every asset class you can. And this is going to sound very hard because there is something that I like to call the neighbor tracking error. So that means that your neighbor has NVIDIA and you don't, because you invested in a very diversified portfolio that has just a tiny bit on NVIDIA, but he put 40% of his wealth in NVIDIA. So he's becoming very rich and you're tracking behind. And that's the neighbor tracking error. And it's going to try to lead you to do stuff to catch up with him. So much easier said than done to have the discipline to remain in a diversified portfolio. But that's step number 1. So take exposure not only to the US stock market, but take responsible exposure to stock markets at decent valuations around the world. So we've had an example on Japanese equities for the last year or year and a half. They've done tremendously well. And we live in a world where we think the US has to be the best performing market, but history shows that's not always the case. So take international diversification, take emerging market exposure, take bond exposure around the world, take commodity exposure, because what if there is an inflation shock? Do you have an asset in your portfolio that does well if there is inflation? But now, even if you do this as well as you can via using ETFs and accessing whatever asset class you can, you will still be facing the same problem, right? What if correlations all move to one? I mean, what happens then? The only asset that tends to do well when correlations go to one is the asset that is the denominator of all these assets. So the S&P 500 is denominated in dollars. Commodities are traded in dollars. Gold is traded in dollars. Bonds also are dollar denominated. So when you are collapsing the system, when you are deleveraging the system, very often you'll see the dollar doing well. And that's because basically the world is based on the dollar being the global reserve currency. So we have leveraged the entire world around the dollar. So you're in a situation where foreign countries trade their goods and services in dollar, and foreign countries issue dollar debt. It's all about the dollar here. That's how we've built the system. So when you compress it rapidly, then the dollar tends to do well. Problem is, how do you get exposure to the dollar? I mean, you need to be able to trade futures. You need to be able to trade specific markets. So at that point, I would say for the standard investor, try to get as much diversification as possible. And then I'm afraid it's a little bit hard to avoid the correlation going to one moment if you have access to alternative investments. So for example, specific strategies like trend following, macro, and I'm talking about now allocating to hedge funds a portion of your wealth. In that case, if you do it well with a good manager that is equipped to actually do well in these periods, then actually that can be the true diversifier in your portfolio.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
I frequently hear people talk about global liquidity, and they love to show this chart of it increasing and increasing over the years. And however, is there a direct and timely link between liquidity, global liquidity, and the price of risk assets?
No. So the answer is no. The answer is no, and it can be simply shown statistically. I have done this for clients over the years. It's always very fun because human brains are wired for stories. Human brains are wired for narratives. Okay. So we want to have an easy and intuitive explanation. We like to think in linear terms and not in complex systems terms. It's already fun if you think about it that you want to use, not you, I mean anyone, will want to use one variable, one single variable to explain such a complex system like the stock market globally. This sounds to me already like a very fun experiment. So it just can't work. It doesn't seem very credible. Then if you run a regression, talking about proper things, if you take liquidity in its form, which is the creation of bank reserves by the central banks, and you can take the Fed bank reserves, and then you can sum Chinese and Europe, and people are becoming now global bank reserve creation. Fine, let's do that. Let's take global bank reserves. If you regress and you use as an explanatory variable the changes in global bank reserves, the changes in global liquidity, and you try to take that and use it as an explanatory variable for subsequent S&P 500 returns. So the exercise, you're testing the hypothesis of changes in liquidity. Do they explain changes in stocks that happens in the 6 months after? The R squared, which is basically the amount of variance in the S&P 500 returns, which is explained by the changes in global liquidity, is pretty much zero. Zero is the result. So basically, they are completely irrelevant. Global liquidity is completely irrelevant as a factor to explain future returns in the stock market. And why is that? Well, if you want to talk about the monetary side of things, it's because when you create bank reserves, when the central bank expands its balance sheet, all they're doing is they're giving money to banks. Okay, so banks now have more bank reserves. But banks cannot buy stocks with their bank reserves.
I have a question about this economic indicator that is so often used, and I haven't heard anyone being able to explain this phenomenon. And that is, from my understanding, every time a country borrows money, they increase the debt, they borrow and spend it into the economy. Shouldn't the economic output, meaning the GDP recorded, be equal to the amount that they borrowed and spent at a minimum of a 1-to-1 ratio? So if they borrow $1 billion, increase the debt by $1 billion, shouldn't the economic GDP also grow by a minimum of $1 billion, assuming there's no multiplier effect? And I ask this because so many countries' economies are growing much slower than the amount of increased debt that they borrow and spend into the economy. How is this possible?
This is an extremely well-phrased question because people fail to understand that fiscal deficits are not necessarily a bad thing. So when a government has a fiscal deficit, what they're doing basically is they're blowing a hole in their balance sheet, okay? They're saying, I am the government, let's say the United States, I am the government that is issuing dollars, I am the government that makes the dollar a legal tender, and I now say that I want to spend more dollars than the ones I'm getting in from taxes. That's it, what fiscal deficit really is, okay? So then we create a system where the United States needs to borrow, quote unquote, okay, fine. But they've done fiscal deficits, okay, which is basically what you're referring to. Now, what are fiscal deficits? They are an injection of resources for the private sector. So, I mean, everybody forgets about it, but when the government does fiscal deficits, somebody's enjoying that. So the fiscal deficits of 2020, 2021, what was that? Well, was the government sending people checks at home in their mailbox, okay? So now do you realize that when you cash in that check, your bank account is going up? It's going up and you have no more debt on your balance sheet to offset that. That means your equity, your net wealth, your amount of richness, your wealth is going up. To answer your question, the answer is theoretically yes to the fact that if the government has fiscal deficit, then the private sector is increasing its net wealth. GDP, though, doesn't necessarily measure the increase in net wealth in the private sector. It's a little bit of a different calculation. And that's why the ratio isn't 1-on-1. It can be a little bit different. It can be 1.5 to 1 or 0.5 to 1. And if you look at history, we used to be pretty good at spending the deficit, at spending the newly created money, at making it a productive endeavor, right? So basically, if the government spent $100 billion in fiscal deficits, well, guess what? The private sector was very smart at using that money for productive purposes. And so we ended up with more GDP even than 100 billion as a result. And now we're pretty bad at it. So when the government spends 100 billion, the amount of marginal dollar of GDP that we are creating with that 100 billion spent is actually less than 100 billion. So let's say the GDP multiplier on fiscal deficits is getting lower and lower. And why is that? Because there is more debt in the world, private sector debt, so corporates and households are more leveraged, which means that when you throw money at them, generally speaking, the first thought they have is, can I take some of this money to pay back some of my leverage? So instead of putting it at productive use, they try to reduce their own amount of leverage on their balance sheet. And the second is, well, we have engineered a less and less productive economy over time because, again, we're trying to kill the business cycle. I always say that policymakers are intended on not having a recession anymore in our lifetime. If they could choose, they would abolish the term recession. But what this does is it avoids the natural cleansing that a recession does. It just kills that process of killing zombie companies and unproductive businesses. It doesn't allow for that. So which means we're becoming less productive and less smart at using this newly created money. But you made a great point, which people fail to understand. When a government does deficits, hello, the private sector is actually enjoying that. So there is this another side of the coin to making deficits and making more debt, which is, well, increasing the net wealth of the private sector. The question is, how productive are you in utilizing this deficit?
Well, great. Alf, thanks for coming on the show. And to wrap things up, is there anything that you're kind of looking forward to or you're kind of excited about as you look at the markets and in your life?
Well, when I look at markets, I think we are in a situation like where the people have thrown the towel, I would say, on a recession. I think it's been called for way too long. I think the yield curve has been inverted. Now it's disinverting, but it's been inverted for 2 years. And so people were like, after the first year of inversion, they were like, there must be a recession now. And it never came. And so people are frustrated to the point that they're now not even assuming a recession is a possibility anymore. And I think that might be a bit counterintuitive, like in 2007, when after the Federal Reserve hiking cycle, it seemed like everything was fine. And then ultimately, a recession effectively came in 2008. I don't think we're going to be seeing another 2008, but I just think that people's attention towards a potential recession has gone down quite a lot. And then when it comes to my personal life, well, I couldn't be more excited, frankly. I just launched my macro hedge fund. It's something that I've worked on for a long time, for 9 months. We've gathered large commitments from investors. We're opening the doors very soon. And I'm very, very excited about that.
Well, great. Fantastic. Yeah, congratulations. So how can our listeners get in touch with you?
My messages are open on both social media platforms I use the most, Twitter or X nowadays, and LinkedIn. So on Twitter, you'll find me at MacroAlf. Well, Alf like the first 3 letters of my name. And then on LinkedIn with my full name, which sounds very Italian, and it's Alfonso Peccatiello. Messages are open, so hit me up. I'm always happy to chat.
Fantastic. Well, Alf, it's been a pleasure. Thank you for coming on Chat with Traders.
Thank you very much, guys. I listen to every show of yours, so it's been a pleasure being on the other side.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
You and I play in chess. I have no strategy and I beat you, and you have a strategy and you lose. So do we conclude that I'm a better chess player? I would say, no, we need to play 10 times. Maybe we need to play 50 times. And then the reality is in markets, that's what we have. You don't have one trade, one investment, one idea. You're going to have lots. And what really separates people is not the one right now. Too many people obsess about, was I right or wrong today versus was my plan good? And if I continue to enact plans like that over time, where am I going to be?
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey traders, it's Tessa here, your co-host on Chat with Traders. We're in episode 290. How's it going? What have you been up to? I hope things are going well for you these days in life and in your trading journey. And at the very least, I hope you are continually learning no matter where you are in your journey. I know I am constantly learning whether I intended to or not, especially in the markets when it felt like things weren't going well on certain days. I know we traders all have those days, but I find that intentionally making it a point to actively learn, especially when you feel that you're at your worst and had a bad trading day, is the most valuable thing to do. And I know this sounds boring, but tracking my trades each day on the same day and reflecting on it takes extra work, but that has been the only consistent way in my process to ask myself, what can I learn from this experience today? And what will I do to improve no matter how small the improvement is? And it's not a perfect process, but this has been helping me so much in my trading lately. And I hope this message resonates with at least some of you. Well, let's get to our interview today. Our host, Ian Cox, interviews Mark Ritchie II. Now, the name may sound familiar to some of you because Mark Ritchie's father, Mark Ritchie Sr., was interviewed in one of the earlier Jack Schwager's Market Wizard series. But Mark Ritchie II didn't simply inherit his place in the world of trading. He worked hard, learning from his father and trading mentors in his life, one of them being Mark Minervini, who was another famous market wizard featured in an earlier Market Wizard book. Mark Ritchie II has achieved his own great accomplishments in his trading career, and we'll hear more about that soon. We don't get as many swing traders on the show, so it's always awesome to have a swing trader to chat with and learn more about the approach, Mark's approach, and trading philosophy. So, ladies and gentlemen, we are so pleased to present Mark Ritchie II from Illinois.
Well, Mark, I'd like to welcome you to Chat with Traders.
Thanks for having me, Ian. Appreciate the invite. As I said prior, you guys have had a great guest list, so honored to be here.
Fantastic. So where are you at now, and where did you grow up?
Believe it or not, I'm coming to you live from Wakanda, Illinois. And for those who've seen the whole Black Panther Avengers thing, the Wakanda was here long before those those books and movies and whatnot, or excuse me, comic books and movies came out. It's not spelled the same. It's a suburb outside 45 miles northwest of downtown Chicago. So I would often say Chicago, but I am not downtown, but that's the closest, major city.
Okay, fantastic. So tell us a little bit about growing up and your early interests.
Classic Midwestern, I would say childhood, great parents, fairly conservative, household. Obviously my dad was a trader. Some people may know that. We can get into that, but I had no interest in those kinds of things. I was your classic, liked the outdoors, played sports, games. Yeah. Regular, Midwestern stuff.
How much were you influenced about the markets by your father, Mark Ritchie Sr., who was interviewed in the Market Wizards book 30 years ago?
Boy, and this is one of these, tell me how long you want to cover this stuff. I would say in terms of, actually being interested in markets, probably zero at the time growing up. I didn't really know what my dad did. He was a pit trader. For those who aren't familiar, just put a little bit of color to things. He was kind of a pit trader in the 70s and 80s, really kind of left that active side of the business right around 1990, worked off the floor for a number of years, and then was just kind of semi-retired. So it was kind of out of trading by the time, like in in a real active, everyday kind of way, by the time I would have been old enough to be interested, so a lot of people think I traded on the floor. I've never traded a minute on the floor. I visited a lot when I was a kid. I just thought, and when I was really little, you knew dad had a busy day if he came home and his voice was hoarse or he wasn't talking much at dinner because he was yelling and screaming in the pits all day. So I had no concept of what markets were or anything like that. As I've looked back, that I do think was really good for me was we played a lot. We were a family. I was one of 5 siblings, played a lot of games at chance, those kinds of things were sort of that probabilistic thinking in real time. I do think that was really helpful. And I've noticed, it's very hard to gauge, what's a good background even. And you talk to different traders, 10 different traders, you get 10 different stories and all, that kind of stuff. But I do think, even gambling, I'm not a gambler, but I understand at least the people who are successful in gambling, how they're not thinking about the teams. They're thinking about odds and probabilities and numbers and that kind of stuff. And so for me,